Ladies and gentlemen, dear colleagues, good afternoon and a very warm welcome to all of you. It's a great pleasure to open the 10th Swiss Finance Council annual conference here in Brussels and to see such a distinguished audience gathered to discuss some of Europe's most pressing strategic challenges. I would like to thank you all for joining us today. Your presence reflects a shared recognition that Europe's ability to mobilize capital and integrate markets effectively will be decisive for its future competitiveness, resilience, and prosperity. Our theme today, Smarter Regulation for a Stronger Europe, speaks directly to this challenge. Europe faces an ambitious agenda, closing its investment gap, financing the green and digital transition, and remaining globally competitive in an increasingly fragmented world. Achieving these objectives will require deep, integrated, and well-functioning capital markets, supported by a regulation that is robust, proportionate, and forward-looking. At the Swiss Finance Council, we firmly believe that smart regulation and open markets are reinforcing each other. When regulation is predictable, coherent, and risk-based, it builds trust, attracts capital, and enables innovation, all while safeguarding financial stability. This afternoon's program will explore how Europe can strike this balance. We will begin with an exchange of views on resilient and competitive financial markets in a changing world, moderated by David Wright, Chair of Eurofi or Eurofi? So let's do Eurofi. I'm delighted that Colm Kelleher, Chairman of UBS Group and also a member of the SFC board, will be joined by Jörg Kukies, former German Federal Minister of Finance. Together they will reflect on how Europe's financial system must adapt to global economic, geopolitical, and technological shifts. We will then turn to our first panel discussion on smarter regulation to unlock investments, moderated by Melinda Crane. This panel brings together an exceptional mix of legal, political, supervisory, and industry perspectives, including Diane Fromage, Christoph König, Christelle Rendu-de-Lint, Sam Riley on the panel. Their discussion will focus on how regulatory framework can better support long-term investment without compromising resilience or market integrity. After a short break, we are honored to welcome Mark Branson, President of BaFin, for a keynote address with the title Turning Ambition into Action, Europe's Capital Markets. Our final panel, again moderated by Melinda Crane, will address financing Europe through integrated capital markets. With contributions from Nick Dreckmann, Laurent Ramsey, Philippe Thiel, Björn Sibbern, and William Wright, this session will examine how market infrastructure, asset management, banking, and policy can work together to deliver a truly European capital market that channels savings into productive investments. Let me conclude by thanking all our speakers and panelists and moderators for their participations. I very much look forward to lively and constructive discussions. It's now my pleasure to hand over to David Wright, who will moderate our first exchange views. David is chairman of Eurofi and previously served as Secretary General of IOSCO from 2012 to 2016. Prior to that, he spent nearly 34 years at the European Commission, holding a wide range of senior roles. I looked them up in the more broader briefing paper. It's amazing. So, David, the floor is yours.
So good afternoon, everybody. Welcome, and thank you very much for a very kind introduction. I'm lucky to have two outstanding people with me to talk about resilient and competitive financial markets in a changing world. Well, it's changing, of course, as we speak. On my right is the chairman of UBS, Colm Kelleher, who just informed me he, prior to taking up his offices in UBS, was in April 22, was 34 years at Morgan Stanley. And I'm not going to list all the jobs he did there, but he pretty well did every important job. He's known throughout the world as being one of the leading thinkers and exponents of finance and banking. He teaches at Loughborough University at the banking school and came from Oxford University, as I did, although I think you were a little bit later than I was.
Too much later.
Welcome. On my left, Jörg Kukies, who, as you know, is the former German Federal Minister of Finance in the last government. Before that, he had been the State Secretary, I think, Jörg, I'm right, for something like 5 years before, something like that?
Yep, 6.5.
And before that, headed up Goldman Sachs in Austria and Germany. He has an outstanding academic career, one to die for, including being at Mainz and Paris, graduating after that from the Harvard Kennedy School, and doing his PhD in Chicago.
Yep.
So two outstanding people to discuss the key issues that we face in Europe and indeed in the world. And Colm, if I could start off with you, because you are a huge, UBS is a huge global systemic bank operating across all these geopolitical fault lines. I mean, what are the main implications for European capital markets and banking regulation in this turbulent situation we find ourselves in?
Well, thank you, David. It's great to see you, and thank you for inviting me here. I suppose I could flippantly say that no good deal goes unpunished, having done the Credit Suisse deal, but nevertheless, it does point to what is happening around the world, which is we are seeing a massive domination of banking by US banks since 2008. The share of capital market activity that's been taken by US banks since 2008 is an incremental 12% versus European players and others. What's happened is, and by the way, if you look at the number of capital markets practitioners outside the US, you can count them on the fingers of one hand. This is the essence of the European problem. We've spoken about it before. The US is a market dominated by market access finance. 70% of lending in the US comes from markets activity. In Europe, 75% of lending comes via the bank, which is wrong way risk. By the way, I am, amongst other things, on the advisory board of the Chinese securities regulator. They very much look at the US model and say, this is the model we want, a markets-based model for access to lending, and we put everything down. Europe has allowed itself to fall significantly behind. The catalog is huge. European equity markets as a percentage of global equity markets are down 45% since 2008. You saw the letter report, you saw the Draghi report about access to investment. We have a structural issue in Europe, which I do think, by the way, we're now beginning to address. But it cannot go on like this because we effectively lose sovereign autonomy and we lose the rights of self-determination. So I think the next few years, and I want to very much hear your views on this, I, of course, am an Irishman, which believes that I'm a great believer in the EU. I'm not Anglo-Saxon. They doubt the EU and what it stands for. So I really think that we are at a crossroads here for change, and it's going to be particularly seen in banking and the relabeled Savings Investment Union.
Thank you very much, Colm. You're coming from the previous German government. The geopolitical shocks, of course, have increased. What do you think this means for Europe today in terms of fiscal resilience, integration, regulation? Doesn't this strengthen the strategic autonomy argument we hear, which was put forward by President Macron and, of course, has been taken up by others in the European Commission?
Yeah. Should I use this? Or? Yeah. So absolutely agree with you that the need for strategic autonomy, capital markets union, savings investment union, all of that, I always call it the chapeau problem, right? You get 27 heads of state and government, finance ministers, you name it, in one room. They will take 2 minutes to agree that it is fantastic to have the capital markets union. But when it then comes to the details, it's much less clear what they want. And I'll give you an example to sort of extend on what Colm mentioned, is this question of what is the right mechanism of transmitting credit to the real economy. The realized default rate of securitizations in Europe, even decades after the global financial crisis of European securitizations, was minuscule. Yeah. Minuscule relative to the United States. I read some books where Colm had a role in during the financial crisis, dealing with all of the risks to the capital of globally systemic banks and how to deal with it. But what is really schizophrenic is that the US reacted to the wrong incentives in parts of the securitization markets in the US by pragmatically changing and modifying the rules and regulations, skin in the game and all of those things that end up working. Europe essentially imposed prohibitive regulations, even though in Europe there were no defaults or close to no defaults. The problem were European banks buying US securitizations and essentially killed the securitization market or left it at flatline. And now I think to test your hypothesis, it'll be very interesting because the European Commission made a proposal on securitization, which from everything I understand, I'm not an insider anymore, is very weak. The German automotive industry and some banks financing the German automotive industry tell me auto securitizations will become more costly, less efficient. The same goes for consumer loan securitizations, et cetera, et cetera. And this is just one example, because I always think it's important to be concrete. Because now there is a movement in the European Council, especially between Germany and France, to say we can't just hypothetically always embrace the savings and investment union, but when it becomes specific, then do the opposite. No. And now it'll be very interesting in the current process whether the rules actually get improved or not. The second example that we can talk about, if you want to test your hypothesis, is my favorite topics, the retail investment strategy, which I think is highly counterproductive against its objectives, but is still passing legislation as if nothing happened. So I think, that's somewhat the problem in Europe, is that we always proclaim the title, but then when it comes to the implementation, it gets very tricky to actually do what we promised in the headline.
So let me follow up with one question there, Jörg, because you were at the coalface for a long time. But do you think that the Commission played its role here? Do you think it was thrusting enough? Did we have decent proposals on the table that just got emasculated in co-decision? Did we vote enough? Should we have tried other means of moving forward, like enhanced cooperation? What do you think?
I never engaged in finger pointing, because I think every time that a minister of a member state blames the Commission, they're pointing fingers at themselves because nothing gets decided in Europe without, especially not at level 1 at least, without the full consent of a qualified majority or unanimity of the member states and majority in the parliament, etc. So I think it is far too simple to point the finger, oh, it's the Commission that's wrong. And in a way, it's a chicken and egg problem. When I speak with Commission officials on why and asked them why their securitization proposal was so weak, sometimes they said, oh, well, because if we had proposed something ambitious, it would have been knocked out immediately by the skeptics in the European Parliament. And so they start from a low level, and of course, it doesn't necessarily get better from there. So I think it would be way too simple to just say, oh, it's the Commission that's to blame, or the Parliament, or the Council. I think now, given all the discussion around competitiveness, we have a unique chance to finally escalate upwards and to finally say, okay, we need to finally see financial markets as a strategic asset, that if we don't get better at that and increase balance sheet velocity and increase the amount of capital that banks can redeploy to the real economy, then we cannot complain that the United States is financing so much more growth in the real economy than Europe is.
Yeah, I think you're absolutely right on what you say on securitization. Just going back to something you said about the European banks losing enormous market share to the American banks post 2008. But we also see is that the reason we see this tremendous difference in valuation between US banks and European banks? Is this the core issue, or is it, the fact that the American banks can do securitization, Freddie Mac, Fannie Mae, velocity of capital? I mean, what is the core issue here?
Look, I don't want to make too much about securitization because, first of all, Jörg, I think securitization is an easy win. By the way, the EU has been talking about it since 2005 and done nothing. Securitization at the end of the day is a fixed income instrument. The real issue in Europe is the equity culture, and that is the essential difference between the US and Europe. Europe trades on a 15 times multiple, the US trades on a 22 times multiple. Why is that? 1, fleetness of markets. 2, the US attracts new technologies which are leaving Europe. Europe has lost a huge amount of relisting. $930 billion has gravitated out of Europe to US listing. People don't see it as attractive. Why? Because Europe is a fixed income culture. It's a 70% bank deposit culture, as we said. There are pockets, however, in Europe, like Sweden, which everybody talks about, where you can see real incentivization and movement forward. But if you look at the pension industry in Europe, it's 42% of GDP. Yeah. The US is 3 times that, right? There's fleetness of capital, fleetness of money. These are structural issues that need to be addressed. Now, they can't be addressed overnight. I like the idea of securitization being done quickly because it's a quick, easy win. But the very fact that we're running into resistance on it is telling you what the vested interest is. But it's where the policymakers in Europe really need to take control. We will not have unanimity on this, and Jörg, you can talk to this in a strong way. We will have to have what we had with the euro, a coalition of the willing. Key people who will drive that agenda and allow us to pick it. I do think from the people I speak to that there's a realization it's there. I went to a speech recently where Neil Ferguson, some of you will know, said, Europe, rubble or irrelevant. And I took great exception to that because his idea that Europe was a desert for investing. However, if you look at the fundamentals in Europe, there is huge upside if we can structure the markets correctly. And again, I just want to repeat, the very fact that China is looking at structuring its capital markets and its securitization markets along US lines and Europe isn't, is a problem. However, I do think there is a huge realization, as you said, everybody knows the problem. The question is how to address it. But I do think that we will start seeing movement. But there is this massive mismatch between an equity incentivized culture in Europe, the structure of our pension funds, what they can do, what they can't do, and where we are in the US.
Jörg, looking at, one of the themes of Brussels right now is simplification. I mean, some people think that, we've discovered nirvana here, the way to the future. Would you attribute to the over-complex European rulebooks a big reason for the lack of competitiveness in certain parts of our financial system?
Yes, absolutely. I mean, on the one side, I fully agree with what Colm said on equity culture. I mean, in the report that I co-authored with Christian Noyer, we identified the lack of pension systems as the elephant #1 dominant topic in the room that is driving the difference between why Europe is at par with the United States with startups, but gradually after Series A, B, C, D, every financing round that you track empirically, the gap widens where the United States grows much more and Europe stays small. And within Europe, the financing that does happen, the proportion of US funds doing the financing grows and grows and grows, the bigger the financing rounds get. And where does the LPs from the venture capitalists come from? Ontario, teachers, CalPERS, Texas, you name it, employees who save for their pensions, who then on their behalf invest in European startups, make them scale-ups, IPO them, unfortunately too often in New York. But again, that's where the argument gets circular, because of course if the valuations are higher in the United States, that's the natural thing for the funds to do. The good news is it's fixable. This is not a Europe versus US thing, because the examples of Sweden, Denmark, Netherlands show that it's not extrinsic to European culture to have a strong equity culture. There's now, I think, very promising legislation in my country, Germany. My successor, Lars Klingbeil, just proposed massively strengthening the third pillar, abolishing the requirement of principal protection, which in the German culture is quite revolutionary, I have to say. I failed abysmally for 7 years trying to get that through. And now, for the first time since decades, we have a chance in Germany to establish a truly efficient, ETF, broad-based equity investing system that is tax incentives, that is benefited, and that is accompanied by a reform of the corporate pension system, which will also encourage inflows into Pillar 2 corporate pension systems, also without the need to principal protect everything. So I would say glass half full. The example of Sweden is exemplary. There's been more IPOs in Sweden than in Germany, Spain, and Italy combined. I find that statistic absolutely striking. And that tells you everything. And you look at the ecosystem of scale-ups and all of that in Sweden, it's really a great example of that these things can work in Europe.
Well, I think you're absolutely right. I mean, this has been a massive structural failure of Europe over decades, hasn't it? I mean, if you just look at the top tech companies in the world, there's barely a European company to be seen, and we haven't scaled up at all, and there have been several reasons, and your report deals with a lot of them. But I think there is a bigger realization now in the European institutions, the EIB, EIF, and also in the Commission, that the scale-up problem, this mid-level financing problem. But I just want to ask you one question here. I've heard the view recently that as soon as an American venture capitalist comes in to finance a promising European prospect, the chances of that promising European prospect listing in Europe is much diminished. Is that right?
Empirically, there is such a correlation. The big question is, what is the causal reason for it? And we spoke with a lot of the VCs and asked them for their decision. Of course, first of all, it's PEs, right? I mean, that's pretty natural. If you've invested in a company, you go where the price that you can get is the highest. But where does it come from? On the one side, I think it comes from this scarcity of equity capital in Europe. But on the other, it also comes from the fact that we overburden our growing companies with bureaucracy and regulations that make it much harder for them to achieve the kind of growth and yield and profitability that they can achieve in the United States. First, because our internal market isn't working as well, and scaling from Nebraska to Arizona is much simpler than from Slovenia to Sweden. But on the other side, I mean, it's quite fascinating. Today, Roland Busch published a very interesting article, what he learned from his trip with the German Chancellor in China. The German Mittelstand Corporate Federation, DIHK, published a paper on what is going wrong in AI application in Europe. And they all point to the same phenomenon, that European rules between the AI Act, the GDPR, the Crypto Resilience Act, the Data Act, the DMA, the Digital Market Act, the Digital Service Act, DSA. Arthur Mensch, I think, summarized it brilliantly in an interview that he gave in Der Spiegel when he said, I'm very happy that I have a valuation of 13 billion, because that means I can afford the best and brightest lawyers who can teach me how to navigate the system. I really feel sorry for those who are much smaller than I am, because it's an artificial barrier to entry into development, application of AI technology in Europe to navigate this huge complexity of all of these rules that are in part contradicting each other. And by the way, I hear the same thing from the German financial industry as well, in terms of what makes it harder to implement AI tools for their client base.
Colm, turning to you on the same sort of theme about competitiveness of the banking system. I mean, I'm hearing that a lot of the big banks in Europe want to look much more rigorously at the implementation of the Basel rules. They want to inject growth and competitiveness mandate into the regulators and so forth. Is this the core of the problem from the banking perspective?
I think the core of the problem from the banking perspective is that regulation is backward-looking. 2008 taught us that the banking system was not adequately capitalized or managed effectively. Huge amounts of work was done, led by the Americans, Dodd-Frank, Volcker, and the capital rules, to the point where actually two things happened. One is we more than adequately capitalized the banking system. In many ways, I think it's overcapitalized if you look at the numbers now. But two, more importantly, we drove a lot of business out of the regulated sector into the unregulated sector. That brings with it its own set of problems. You've heard me speak about that before. We're beginning now to see the consequences of that. Have a look at what's happening in private credit. Anyway, the point is this, is that the Americans, as always, realized that bank capital had been dealt with. So what they wanted to look at was the other issues in the regulatory framework that made sense, liquidity framework and so on. And then they wanted to look at how do they get their banks lending into the economy again. You will have seen a report by Alvarez and Marcel that came out recently that is showing that $126 billion of capital has been released from the G-SIFIs in the US. That will generate, if it's lent, $2.6 trillion of lending capacity into the US. By the way, the idea that these banks will just buy shares back is not what this is about. It's a happy mix. We have somebody from BPI here who can talk about that on their panel. But in many ways, Scott Bessent sees the mobilizing the banks to drive the economy. And the US very much has a competitive bent to the regulators have a competitiveness mandate. The UK has been given a competitiveness mandate as well. Numbers not quite as extreme, but still very much liberalizing. I think the term we should use is simplification rather than deregulation, because it's about refocus. In Europe, as always, they're not yet decided what to do. Letters have gone out from the European Banking Agency and the EFR to Ursula von der Leyen and others saying that Europe should be given a competitiveness mandate. And I don't want to be quoted, let us not talk about what's happening in Switzerland. So what you've got is this massive mismatch around the world in terms of regulatory speed and what needs to be done. But there is no doubt that a competitiveness mandate allied to a sensible regulatory framework can only be good for the economy.
So when you consider all of this, I mean, we see a sort of, as you said, an American thrust through stable coins, through reducing capital requirements on the U.S. banks. I mean, you're at the frontier here. Is it your sense that in the European Union, we've got a crucial European Council coming up on March the 19th, which was meant to cement conclusions on European competitiveness. It might get derailed now because of what's happening in the Middle East. But is it your sense, I mean, you use the figure that banks finance 75% of the economy. Is it your sense that sort of banking is part of this stuff? Or is it focusing, SIU, a savings and investment union? Because it does seem to me logically, if you want to improve the competitiveness in Europe, you want to improve the competitiveness of your banking system since it finances 75% of the economy. Do you get the sense that that's the case, or is it going to be locked up in a 93-question European Commission questionnaire which has just come out?
Well, I think it's much more complicated than that, because whilst I think there is a willingness within the EU to address these fundamental issues, what we've also got is a situation where now more than 50% of non-banking activities, which is $230 trillion, is not regulated like banks, and that is attracting shadow banking. And shadow banking brings with it the lack of a social contract. Whether you like banks or not, banks are part of a financial ecosystem that have a stakeholder construct, and they have obligations. And for that, they get privileged treatment as deposit takers and so on, but they don't get to gouge investors, savers, and so on. So I think the FSB now fully understands it has to address this issue. Now, of course, within the so-called NBFI, you have insurance industry, which is very well regulated in certain parts of the world. In Europe particularly, but it's certainly not that well regulated in the United States. And we're beginning to see things happening here. So I think there are a number of themes here converging. The main thing for Europe is to make sure that it has a balanced savings and investment union with capital markets access, and markets access which allows markets to grow and this so-called equity culture to develop, and not for it to be strangled. And too much, personally, I believe the ECB is, and unfortunately I'm not regulated by the ECB, unfortunately I'm regulated by FINMA, but that's a separate issue. But the ECB is so formulaic on the way it looks at things, because it has not got a competitiveness mandate, as some of you know, that it is choking off, in many ways, growth. Look to what's happening in the US, look to what's happening in the UK, look to what's happening in Asia to see how banks can be well regulated and still actually promote economic activity on a sensible and sound basis.
Just on your point on non-bank financial institutions, which the FSB estimates, what, 50% of the global?
51 now,
50, yeah. You think that you face an unfair competitive disadvantage compared to the way they're regulated in general?
No, I don't, because I think, I think other things are threatening banks. For instance, crypto could be threatening banks, but in many ways, we've always reacted to interloper challenge, and because we are deposit-taking institutions, we have a certain degree of protection, and we have to grow and react. But I think at the margin, certainly what you're seeing, I mean, private credit isn't enough to be systemic, but let's say the outstanding in the market is $3 trillion. Well, you've already seen what can happen when that goes wrong. That causes a fiduciary challenge rather than a systemic challenge. And the question for regulators, which is in the long run, and Jörg, I'd love your view on this, which is more dangerous, a fiduciary or a systemic challenge? In many ways, you can deal with a systemic challenge, as we've shown you can, but a fiduciary challenge is all about trust in the system, and that's where I think there is a bigger issue, if that answers your question.
Jörg, when you look at Europe today, we have basically a tremendous financing capacity in Switzerland, an even bigger one in the UK. So two big poles of financing capacity outside the European Union. And as far as I'm aware, not an awful lot of negotiation going on about how to bring together that in not one whole, but to make capital and people circulate better for the good of all member states. Now, do you think the time has come for us in Europe, particularly given the behavior of the current US administration, who have said some extraordinary things against Europe and are clearly not a friend anymore? Do you think the time has come to think wider? In other words, to think continental wide in Europe, probably with different structures, but so we can build in that structure a really big, deep capital market, which would be over time a rival to the US?
Well, I mean, first of all, on Switzerland and UK, I've always been vehemently opposed to playing with equivalence. And I think we all made the mistake that, like this playing with threats and counter threats on granting, withdrawing equivalence, at the end of the day was a lose-lose situation for all discussions. It's good that at the end reason prevailed, and after some back and forth, constructive outcomes were found, but of course we lost some time and maybe trust in that process. The discussion, I think, is, of course, on continental Europe is a much wider one. Personally, if you look at the development of Poland, the Czech Republic, and other countries, just imagine the European Union didn't wait for 23 years to integrate the West Balkans into the European Union. Imagine the European Union had been much quicker in integrating Ukraine into the European Union. Of course, it requires staggered approaches and difficult, but that could massively increase the size of the internal market. Of course, governance issues will have to be addressed in that process, but the geographic expansion potential of the European Union can be quite appealing, and I think is one of the big opportunities that we have in Europe, but that cannot reduce the push for a stronger internal market. Whether it's the IMF, the ECB, all studies that look at costs of transacting within the internal market of the United States versus costs of transacting within the internal market of the European Union, Europe loses, like 44-0 or 44-10, whatever it is. So that, I think, is a huge problem, and it increases with financial with services. That number is almost triple digit, in some areas even triple digit plus, so that for services, the barriers to trade in the internal market is even higher. I mean, the best example is the fact that if a bank wants to move capital from one European member state to another, or liquidity, or both, it is faced with massive restrictions on doing that. And I think that is one of the construction deficiencies of the European Banking Union, that we only talk about the third pillar, the deposit insurance, as the last pillar to be accomplished, and forget that even if we accomplish European deposit insurance, and I think there's ways to deal with that rationally, we haven't achieved anything if we don't allow more liquidity and capital to move between European member states.
Are you, a slightly different question, but are you strongly in favor of what is called the 28th regime in order to help particularly smaller companies, but why not all companies, to trade across the European Union with one set of corporate governance, corporate rules?
Yes, I mean, that's a core part of the report that I wrote with Christian Noyer. We think from birth to IPO, that's how we call it, every European company should be able to set itself up in a pan-European framework from day one, online within 24 hours. But then importantly, stay within that framework in a legal construct that allows capital to be added freely and flexibly, giving the founders some special privileges that they also have in other successful capital market economies like the United States, all the way up to the what we call IPO on-ramp, where we think we shouldn't set up new markets that permanently reduce the standards, but as an on-ramp, maybe allow companies for 3-4 years to live with a bit less data reporting requirements than companies that have been listed for decades. So yes, I completely agree. The SE is the prime example that always gets named, but please look at the SE in detail. It is not pan-European. There's 27 different implementations of Société Européenne, and it only applies to companies that are large enough, that are either subsidiaries of big banks or listed companies. The SE regime is of very little or no hope or help to startups, and only in a limited way to scale-ups.
Turning to you, Com, same sort of question here. I mean, should we be thinking broader now, Europe? So the European Union, Switzerland, UK, Norway, others, in a much bigger continental-wide approach to all of these issues, given as I said, about given the United States. Because if you look at the state of, say, EU-Swiss relations today, I mean, there's been a little bit of progress in, I think, in veterinary areas and research and stuff like that. But the big stuff, I would argue, is not moving forward. What do you think?
Well, I mean, clearly, yes, we'd like it. But look, being a third country comes at a price. You're not a core signatory to the treaty, to the union, and you should not be treated in the same way as full-blown members of the union. Having said that, where you bring value, there should be reciprocity, equivalence, or whatever it should be. The loss of the UK from Brexit, which I was very anti, hit Europe hard. It hit the UK very hard and hit Europe hard. The UK was a repository of fantastic banking and capital markets expertise, which could have benefited Europe and still can. Switzerland has the same degree and skill set, which you can do. So this idea, without impugning the integrity of the union, and I get the arguments, the idea that you can have the EU++ that works to everybody's advantages, I think makes an awful lot of sense. But we have to pay for that privilege as well, but I think we get out of that what we put into it and more. So I very much like it. I mean, I remember when I first came here a few years ago, the standard EU line was, you're a third country, go outside and don't talk to us. But I think that's changed a bit. Yeah?
Com, let's just finish off, if I may, with your thoughts about AI in terms of banking. I mean, is this revolutionary? Is it going to greatly enhance the efficiency of European banks, or should we be fearing its implementation? How do you see it?
Well, I think it's truly revolutionary. I think in the first instance, simple AI is massively about cost reduction and taking operational friction out, removing the gates. I think banking has always been threatened and has benefited from technology. The example I always give is when the equity markets went fully electronic, everybody said it would destroy the investment banks trading in those markets. We'd lose bid offer and get carried out. What actually happened is we did lose 92% of bid offer, but volumes went up 15 to 20 times. So those banks like Goldman Sachs and Morgan Stanley, who were able to invest in technology, did incredibly well out of this, and it became a very efficient, frictionless business for their clients. Now, frankly, AI should do exactly that now for our clients. It should take a massive amount of cost out and take friction out. And in many ways, yes, it will reduce headcount, but it will reduce ineffective headcount and allow us to relocate and repoint headcount everywhere else. In terms of AGI, I'm not sure where we're going with that yet. There's no evidence yet that we're getting there, but I can certainly see the adoption by UBS, the number of co-pilots we have, the fact that our AI investments are now self-financing already and will actually be revenue accretive from next year in terms of cost accretive in terms of production of cost from next year, I think is only good for the banks and is only good for our customers and shareholders.
In our last Eurofi or Eurofi, we heard the view from a number of American banks that, they were just way ahead in terms of implementing AI, and that was part of their efficiency gains and so forth. I mean, how do you look at this in terms of the financial sector? Is it a big opportunity? Are we behind? Is it a big opportunity? What do you think?
Well, I mean, as Colm says, unambiguously, it's a huge opportunity. I mean, I just thinking back in the days, like young financial analysts fresh out of universities, what were they doing, right? Writing presentations. If you can now ask an AI to write the presentation for you, just imagine the 22-year-olds can cover clients and start getting real financial industry experience instead of spending 3 years where they really can learn a lot writing presentations or pitch books and all that kind of stuff, right? So I do think it's not like that talent pool will not be employable. I think different qualities will start becoming relevant. How good are you at prompting an AI to spit out the right type of presentation and the right types of information that you need? That will be a lot more tech-savvy people entering the banking scene. But on the other side, I think young professionals will start being able to have client interaction at a much younger age because a lot of the tedious work can be digitalized and automized. So I think that's point one. And of course, a huge amount of the processes, credit applications, data collection, et cetera, of course, there's a huge potential for automation. So that's a huge opportunity. For Europe, it's a bit of a threat because if I look at just the profit pools that the US banks have to reinvest and to fund their CapEx needs is just such dimensions bigger than the aggregate European banks' profitability. So in that sense, who will be able to have much more CapEx in this area? I think that is a threat to the European system in a way.
One final sort of set of questions before I put you on the spot on the one change that you'd like to see above all others. Just a quick word about the crypto and stablecoin markets, Colm. Is this something UBS is very involved in, you believe in, or do you think a lot of it is hot air?
No, I think that what we have is a revolution in the payment rails, and that technology will fundamentally change everything going forward. The fact that you want to move money from your London or Leicester office to Uttar Pradesh to your family, and currently is 15 breaks in doing that, is clearly unacceptable. The fact that you can use some form of crypto coinage to do that in a real time is obviously of huge value. Now, I would pass this. I think there's a big difference between stablecoin and crypto in terms of coinage itself. I'm still a great believer that if you give the average customer real-time access and real-time settlement on real-time payment rails, then the demand for the other stuff goes away. And it's up to the banks to get up to speed on this stuff and make sure they have the rails. Stablecoin itself is interesting. It's being adopted. Of course, we've seen the Genius and Clarity Act in the US. It's a means of financing the US government potentially, but even that isn't fully clean yet, and there is a real risk of basis risk in stablecoin with the underlying portfolio. I have yet to be convinced about Bitcoin or Dogecoin or Trump coin or any of these coins as to what they mean. Certainly we at UBS are not promoting that product. If our clients want it, we're looking at maybe executing, but we don't provide it on a fiduciary or an advisory basis at the moment. It's too premature. I think stablecoin is here to stay, but the big question I would ask everybody is, if it's about the technology and real-time and immediate settlement, then what are you getting from it other than what can be provided by a well-functioning bank anyway?
You.
Well, point one, and this might be a bit controversial in this town here, but I personally think Europe lost a huge amount of time in this race by focusing on the wrong priorities in terms of central bank digital currencies. The German government's position was always, if there is a justification for CBDC, it is in the wholesale institutional market, it is not in retail. Retail is up to banks and businesses to develop. In wholesale, I still remember we had a working group of the Bundesbank, the BaFin, SAP, Siemens, startups, scale-ups, you name it, a lot of brilliant technologists who developed real-time DLT tokenized machine-to-machine payment applications that the central bank digital currency, if Target 2 had been invested into and made better and brighter and more staying within the tokenized world. Unfortunately, at the beginning, that was just completely rejected, and the focus was completely on the retail application. So I think Europe lost a lot of time, and the same goes for stable coins, where everyone who wants to transact stable coins now does so in dollars. So Europe simply is so far behind the scalability of retail applications of scaled assets that stablecoin is now at the moment, if you look at the big providers, a complete dollarized asset. And that could also at some point become a problem for Europe. We're seeing the first issues already if you look at the details of some waterfalls of potential default if something goes wrong between US holders and European holders, et cetera, et cetera. So there is, I would say, a lot of risk in there that hasn't really been explored yet, and that is difficult to explore, and that is just happening outside of European jurisdiction because we've somewhat missed the boat on that asset class having developed, and there's just no asset to regulate in Europe because the volume is close to zero.
So just a very 1 minute thought each. If I put you in the hot seat, Colm, and ask you, what is the one measure that you really think would shift the dial in terms of Europe, integration, building its capital markets, etc.? What would you say?
I think what really shifts the dial is pension reform and equity incentivization within the Savings and Investment Union. And I think the UK and Switzerland should be invited into that.
I mean, number one in the report that I cited that I wrote myself is pensions, 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 right? So in that sense, I couldn't agree more. The only issue is it's not a very Europeanized thing. However, maybe that can actually be positive because if Germany now moves ahead and some other member states move ahead, Christian Noyer also is proposing our report to the French authorities, and just imagine Germany and France together moving ahead on equity-linked pension reform, what powerful signal that would be. And if you then look at countries like Italy, where retail distribution of equity products tends to be enormously strong, believe me, I know what I'm talking about because I used to be the head of Germany competing with the head of Italy, and the Italians just have such distribution power. It's really, really impressive. So the affinity to buy product there definitely exists.
Well, we've come to the end of a really most interesting discussion here, and I thank you both on behalf of us all. It does seem to me March the 19th, the European Council coming up, is really important. It may get waylaid by what is happening in the Middle East, but the conclusions of that European Council, assuming it stays as is, I think can provide a catalyst to real movement. And let's hope that that's the case. We've all been struggling for long enough. But I think both of your views are really appreciated here, and I ask you all to give them a warm round of applause. Thank you. Thank you very much.
Thank you. We'll do this.
Thank you very much to Colm Kelleher and also to Jörg Kukis for the very clear messages that we just heard, and also to David Wright for so ably leading that discussion, which in fact has provided a lot of excellent input for our panels. And before I launch the first of those, let me just say also from my side a very warm welcome to this year's annual conference of the Swiss Finance Council, and happy 10th birthday to the SFC. It's really a great honor to be accompanying you once again as moderator. And our title of the first panel is Smarter Regulation to Unlock Investments. We just got a very clear reminder from our speakers about why simplifying European banking regulation is so critical at this moment in time. And when we talk about the title aspiration, the aspiration is there. It seems to be, at any rate. The European Commission is now currently reviewing the ECB's report from December that lays out specific recommendations for reducing complexity related to supervision, to capital requirements, to reporting. Yet, as we were just reminded, aspiration is not enough. And as I was listening to Jörg Kukis and Colm Kelleher, I kept remembering Enrico Letta's call at this forum exactly a year ago, actually a little less than a year ago, when he said, you know, we know what needs to be done. We have no lack of recommendations about how to proceed. We just need to do it. So our focus now in this panel is how we do it, how we move from the aspirations to really implementing simplification on the ground. And we have an excellent roster of panelists to talk about just that. It's my pleasure now to welcome them, and I'm going to keep the introductions really short to maximize our time for discussion. Diane Fromage is Professor of European Law at the University of Salzburg and Deputy Director of the Salzburg Center of EU Studies. She's also the Principal Investigator of the University's Jean Monnet Center of Excellence EU Challenges Initiative, which is partly supported by the EU Commission. I'll ask all of you to join me as I read off your names. And Diane, if you would take that place, please. It's also a great pleasure to welcome Christoph König. He is Deputy State Secretary of and head of the Planning and Strategy Division in the Swiss Finance Ministry's State Secretariat for International Finance. Great to see you. Welcome. You can take the place right next to Diane, if you would. Christel Rondu de Lint is the co-CEO of the Swiss-based, internationally active investment firm Vontobel. Prior to taking up her current post 5 years ago, she held leading positions at financial institutions in the UK and in Switzerland. Great to have you with us again, Christel. Please, that'll be your seat right there. Sam Riley is Senior Vice President and Head of International Regulatory Policy at the Washington-based Bank Policy Institute. She leads work on cross-border banking issues and international prudential regulation involving U.S. banks. And prior to joining BPI, she served in various senior roles at the Bank of England. Really great that you could make the trip and be with us. Please, Sam, join us on stage. That'll be your spot right there, next to Christel. And as a policy voice, we had hoped to have with us Andreas Schwab, who's a member of the European Parliament and chair of the Delegation for Relations with Switzerland, but unfortunately he had an urgent appointment this afternoon that prevents him from being with us, which we deeply regret. But it will give us a little more time, which is nice, and possibly also allow us to take some audience questions, which I would very much like toward the end. So let's start with simplification. And just now we heard Colm Kelleher and Jörg Kukis sharing their priorities. I'd like to get your own perspectives now on what you think is absolutely top of the list. And I'll start with you, if I may, Christel. As co-CEO of a bank and asset manager that operates across Europe, where do you see the main structural weaknesses in the current EU regulatory framework? And conversely, what do you see as the top priorities for reducing complexity?
Yeah, thank you very much for the question. So I'm going to speak now about the EU. As a Swiss, about the EU, but it's generic, right? Because it could apply to any regulatory regime or that might be evolved. So factually, I think many of the problems have been mentioned before. It's the quantity of regulation, the complexity of regulation, the fragmentation of regulation. So the quantity has been mentioned already in terms of number of pages, but just the statistics. 20 years ago, the average length of the legislative text in Europe was 4,500 words. It's now 8,500 words. So that just gives one example of the quantity of the regulation. The complexity is probably the most problematic of all, because complexity never ever solves anything, never ever reduces risk, quite the opposite. And when you take, the ESG regulation, for instance, the CSRD, where the firms have to fill in more than 1,000 data points, doesn't achieve much. Transaction reporting, if you do transaction reporting, as a participant, actually, even as a private participant, you would have to fill in 60 to 100 data fields and have timestamps of milliseconds, which is 10 times more accurate than the European Games, just as an example. So it just defies the purpose entirely. Now, fragmentation, I can have sympathy for the difficulty of having a standardized regulation. We've got 26 cantons in Switzerland operating very autonomously, 27 countries obviously in the EU. But the truth is, this is something that has to be addressed. If you want to reclaim withholding tax, you've at the moment got 450 tax forms potentially to look at. So that just to give a sense of what firms as well as participants have to go through. And ultimately, we shouldn't lose the goal that we have in sight, which is the saving and investment unions and ultimately the retail participation as well, because those capital are needed and the impact is already seen. Equity participation in the US is 55% of the population is participating. It's 49 in the UK, it's 18 in Switzerland. It goes down below 15% for Europe. So it's 15 for France, it's 14 for Germany, it's 7 for Italy. And so I think the simplification is the main target. Regulation ought to be sustaining or be promoting sustainable activity. And in that, you've got sustainable, which is about trust, is about protecting. But you've got the word activity in that. And it has to be made possible. And right now, it's just choking it at the source, I'm afraid.
We heard Colm say several times he does see movement. Do you see movement?
I hope so, yes. Yes. If Colm says so, I have to say yes, we do.
Diane, take us through the legal and the political realities, if you would. We are hearing both the Council and the European Parliament calling for massive simplification of the financial playbook. Do you think a genuine simplification shock is actually feasible within the current EU structure? Or does market heterogeneity, basically, and we were reminded about how broad that heterogeneity is during that fireside chat, does that simply make it too difficult to transmit that kind of a shock?
No, thank you very much for the question, and thank you for the invitation again. I don't think the problem is the market, really. I think the problem lies elsewhere within the European Union. And I think the first aspect is the coexistence that we have within the EU between the EU 27 and the banking union, which in the banking sector then leads to a myriad of rules that then come on top of each other and are very different. But it also has, of course, institutional impact, whereby we have this division between the responsibility of the European Banking Authority and the ECB and so on and so forth. So that's for me the first obstacle, which quite frankly I don't see why or how we could overcome. The second obstacle that I would see within the EU today is has to do with political will. I think the first issue that we have is that we had this architecture with the 4 levels, the Lamfalussy architecture that had been devised, whereby we had level 1, setting the rules and the overall principles, and level 2, looking at the implementation, level 3, so soft law, allowing everything to function, and then level 4, enforcement, in particular by the European Commission. And it is my opinion that all of this has come together at this point, whereby sometimes level 1 is extremely detailed, and other times one could argue that soft law measures, so level 3 is quasi-binding. So, I think there is this problem of intertwinement, and we see, in my opinion, also an increasing tendency to not agree at level 1 and then let the regulators, or the supervisors coming together in the European supervisory authorities to then decide on issues that should have been decided at level 1. And for me, the third element has to do with the architecture of how the financial market and banks in particular are being regulated. So we have this logic whereby we have 3 agencies that are supposed to regulate 3 different sectors, which, by the way, differs from what we see in the majority of member states, where it's usually 1 authority or 2 authorities having to deal with those financial sectors. At the EU level, we have this clear distinction between the 3 authorities. And at the same time, on top of that, we have a layer of legislation that is horizontal, AI Act, GDPR, and the like, that comes on top of what is already demanded from banks from a sectoral perspective, which leads to very much complexity. So to answer your question, yes, is it possible? I think it's possible, but only if we have a very strong reform on how we operate at the European level.
Thank you. And you're essentially calling for strong structural reform, a big ask. So, Christoph König, the EU often leans toward quite prescriptive, granular rules, as we've heard several times. As it looks to simplify, what do you think it could learn from Switzerland's approach, which is a much more principle-based take on rulemaking? And tell us a little bit, perhaps, about how the Swiss approach works in practice and whether it could achieve the same level of investor protection without adding so much bureaucracy.
Okay, thank you very much for the question. I think I just take a line of David. I'm not sure whether Switzerland is really the nirvana. And then also the question would be to whom the nirvana could be. And we also have heard several actors also having and struggling with Switzerland as well. But nonetheless, what we certainly see is having a competitiveness framework in Europe will be key also for Switzerland. We have embarked on the journey of financial stability and supervision, I would say, in a much more principles-based approach than the EU, also out of having the need to create a single rule book. They have ended up with a more prescriptive framework. So Switzerland has, I would say, a linear framework when it comes to the level 1 elements. However, when it comes then to implementation, certainly also we do have challenges as well. A principles-based approach does not mean necessarily to not look at the key objectives of financial stability, integrity, as well as financial investor protection. It is more about nuancing its approach to where the risks emanate from. So identifying the risks and then take a targeted approach, which is more or less a proportionate approach to the risk that financial markets entail. And so leaving room to the economy to evolve. What is also entails in the Swiss approach is a constant dialogue with the stakeholders at all levels. And we like to have a dialogue in Switzerland that slows down processes quite a lot, provides stability. However, also it gives much more legitimacy about the risk that some wants to take. So, and also in terms of the citizens, what kind of approach of risks they want to take. In terms of concrete examples, we do have introduced a small banking regime a few years ago. I think Mark, who might be in the room, has introduced that, where we certainly do look at capital and liquidity requirements, having them fulfilled. Also, certain categories of banks can actually benefit from reliefs that the supervisor does provide, in particular when it comes to reporting requirements or audit requirements. And we should not forget, one of the bureaucratic red tapes often comes also from audits and audit companies that do then also make their own interpretation. We also have, when it comes to open finance, not embarked the European track on regulating the opening up of APIs, but rather having the industry developing themselves the standards. Sometimes they are sluggish, sometimes we are looking whether actually they should have more nudging through a regulatory approach. However, it gives them into a space of self-regulation, coming up and providing their own infrastructure. Last but not least, in particular for coming to the question about mobilizing investment, what we see in Switzerland has been key and remains key is the openness. In particular, having foreign actors providing credits into Switzerland, they do not have any a barrier as such. So there is not the need actually for them to look at compliance and having I would say the difficulty of making a decision to invest into Switzerland, but rather it is a system where they have the possibility to provide the investment, which also is to the benefit of Switzerland. Thank you.
Thank you. And I think interesting the point that both dialogue and having industry stakeholder input can essentially ease the implementation phase. It can perhaps make the design phase somewhat more cumbersome, as you say, but once you're then putting it into practice, possibly make that part of it a little bit smoother. Sam, we heard that Switzerland's not the nirvana. Let's talk about whether the US is. And we heard Colm expressing the hope that you would tell us a little bit more about whether and how US recent regulatory reform, in fact, is making regulation more effective without compounding risk, and whether the EU can perhaps learn from the other side of the Atlantic, at least in this respect.
Yeah, so I feel sort of odd. I'm a British person in the EU speaking about American regulatory approach, but maybe that makes it easier. So yeah, I think there is a lot to be learned. There's for the EU and from the EU for the US. I think one thing that I would sort of focus on is sort of stepping out of the politics and thinking about, you know, the words that we use. What we're advocating for is not no regulation, a world pre-2008. We already have very resilient banks. You know, every stress test says that our banks are well capitalized, good liquidity, very extensive crisis management processes and procedures. And, you know, perhaps stepping back from this sort of deregulation as a message and thinking about calibration. So do we have the calibration right? And is that calibration starting to impact growth and innovation and competition? And in the US, we've seen, you know, a willingness to sort of step back. And I think this happened prior to the current administration. Perhaps it crystallized at the point of Basel III proposal, where people said, actually, no, this is too much. Wholesale capital increases without clear reason or clear tying to risk is actually unhelpful for growth. And as we've heard from the stats, stepping back from that has released more capital into the US and, you know, increased investment, increased growth. It's not about taking things to a more risky place, but it is about looking at whether the rules we've got actually are effective, managing actual risks, effectively calibrated for the risks that they're managing, and whether or not they work in the way we expected and intended. And I think in the US, there are a few examples of where, concrete examples of where they've sort of taken a step back, and I wouldn't like to prejudge the Basel rules, which are apparently coming at some point this month, before April. But, a willingness to sort of step back and say, actually, we don't want the opacity of, say, a Pillar 2-like framework. We will publish our stress tests for comment. We will allow people to see these and determine whether or not they make sense. That sort of transparency has been a really positive feature, I think, of what the US is doing now. It's easier for people to see how the capital is being determined, who is holding it, and that is a really important element of something that I think Colm was talking about earlier, predictability. If you have an investor, a very sophisticated investor who can't predict capital, why it's being held the way it is, they're not going to be comfortable investing. So those are really important features. And then I think the other one is sort of on the supervisory side, which is quite a good example, where, SVB in 2023, generally, people have looked at how that was dealt with and the failure and the lack of focus on the risks that really matter. And actually, Mickey Bowman at the Fed has said what we really need is sharper supervision, not more supervision. SVB was fairly intrusively supervised. They had over 20 supervisors. When they failed, they still had 30 outstanding MRAs, which are matters requiring attention, some of those related to the interest rate risk. But actually, they were focused much more on the process and tick box exercises and not actually focused on real risk. And those things, I think, they shape how regulation and supervision is done, and they have an impact on investor confidence in the market. So I think those things we can learn from, take away the political rhetoric, take away the deregulation back to what was pre-2008 and focus on how to make what we have better calibrated.
Thank you very much. Let's do a second round of discussion now to talk a little bit more about how Europe can turn savings into investments, because this, of course, is a key impetus for the EU push to reduce regulatory complexity, the recognition that it is absolutely crucial to unlock much-needed capital for investments that will boost European competitiveness. And I'd like to ask all of you to talk a little bit about concrete examples of regulatory reform that can do that can underpin that kind of process. So Diane, if I may start with you, many EU rules, as we've said, are accompanied by very granular level 2 technical standards that can impede investment unintentionally by essentially creating complexity both for providers and for clients. So from a legal perspective, how do you think these could be designed more smartly without sacrificing clarity and also enforceability?
Yeah, thanks a lot for the question. I think, like I said before, I think it's very difficult to take level 2 in isolation from level 1 and level 3 because, well, they have to respond to each other and essentially depend on each other. So I think one aspect I would also like to insist upon is also level 4, so the question of enforcement. I think one aspect that is currently potentially an issue is that we constantly, add a new layer of rules without having made sure that whatever we have in place is being enforced and so on and so forth. So that would be the first aspect that I would look at. In terms of level 2 specifically, well, like I said before, I think the issue sometimes lies with level 1, which should have defined some of the aspects instead of leaving it to level 2 and then leading on occasions to disagreements between the supervisors that then prepare level 2 and those that have been at the council agreeing on level 1. I think you have this problem in some member states of sometimes communication between those that sit at the table in both occasions. And relatedly, and going a bit beyond your question, if I may, I think there's a question of transparency and a question of control, because if you look at how level 2 texts are being designed, at the end of the day, it's very difficult to control whatever the EU agencies are doing. They will go to Parliament a couple of times a year, but it's so technical that it's very difficult for control to be exercised. And at the same time, who is controlling the NCA when said NCA goes to Brussels or Paris or Frankfurt in that case? So I think you have, this gap, and I think the issue is that it's a growing tendency that more and more is left to level 2, and at the same time we have this absence of control.
Thank you. Christoph König, if we look at the broader retail investment landscape in Europe, both at local EU and also at member state level, there's rising concern that in order to meet Europe's very urgent investment needs in fields ranging from digital transformation to decarbonization to defense and security, we absolutely have to, as I said earlier, unlock more investment. So where do you identify further potential to turn Europe's pool of savings, which is really actually quite large, but as we've heard, there is not an equity culture that sees those savings get channeled into the markets. Where do you see potential for that to happen?
Well, I could put it quite simply. There are a lot of funds and savings in Switzerland that could be mobilized. And would be ready to be invested also further in Europe as well. I just want to come back to one point on the regulatory landscape. Looking at the US, I wouldn't say that the US has an easy regulatory landscape looking at the federal state regulator, the various authorities. So I was wondering whether that is just where we all need to focus on for most. It is rather than in the particular implementation of them, not the structure of it, on how we do look at risk. Just looking at what kind of risk might emanate from cross-border activities. Instead of just saying retail investment is something we have to apply investor protection laws in a very harsh and rigid manner. There are certain segments where actually risks could spill over more than in others. And in particular, when coming to third country providers, as said before, we have made good experience actually in having investments from abroad into Switzerland. It created then also more allocation possibilities and opportunities. So this is certainly a way where also Europe could look at more. When speaking about Europe, I still believe that Switzerland is part of Europe. And so made with Europe, made in Europe, certainly should also have an approach to it, looking at Swiss and UK funds as well. And it has also been said, pension funds are to be mobilized further. I think that is something where also it will also help then in enabling and more fostering the financial literacy by the citizens, just also to have a knowledge about investing into not just also into equity as well.
Yes, thank you very much. Crystal, a streamlined, well-functioning regulatory framework is clearly crucial not only to incentivize investment, but also for financial services providers like yourselves. What barriers do you see for Vontobel and for Swiss finance industry players in general when you want to try to offer solutions for European savers and investors? Where do you run into a wall?
Well, one of the main obstacles is the fact that there's no common market approach. So it's all of a country-by-country approach, which makes it extremely cumbersome. The new regulation that's coming, actually, CRD6, which will impose to have a branch or a license to operate in a given country, etc., will only actually increase those barriers further. So that is definitely the one obstacle which prevents Switzerland in particular and Swiss financial institution to activate the money on a cross-border basis. And I can get, obviously, Europe has to oversee what we will do as Swiss financial institution in those markets. There's also, it's completely understandable that we shouldn't have the same treatment. We're not within the EU, it's, with third countries, but we shouldn't lose sight of the target and the benefit that could be brought to the EU, which is bringing this capital back. The capital's gone, so the EU would be well advised in a sense to try and make it attractive to come back, to try and make it attractive for those clients, those investors, to invest into Europe's future. And one proposal that we've been working on, obviously, on the Swiss Finance Council, is to propose an institute-specific approach, where an institute would go on its own and say, I want to, subject myself to the regulation in whichever country I'm going to operate in, but that you can at least go into a central supervisory authority. So that is a pragmatic proposal. There can be other approaches, but the whole point is that we have a common interest, there's no question about that, on Switzerland being able to activate the funds, but in Europe in being able to attract the funds or attract them in the first place. Because right now they're sitting idle, basically. That is what's happening.
Exactly, thank you. Sam, if we look again at the US, perhaps you can talk about two aspects of equity culture. And first of all, overall, we discuss this in practically every financial sector forum that I attend. Why is it that Europe seems to be indifferent, if not averse, to equity investment on the level of citizens, and how we change that? And perhaps you can talk then in that context also about where regulations actually have helped encourage broad participation in capital markets, what you say has had a notable impact in that area.
Yeah, so I think that the one thing that perhaps the EU struggles with is that the US finds much easier, for understandable reasons, is, harmonization is, there's a significant investor protection regime in the US, which provides a lot of comfort and trust to retail investors and other investors. But that is harmonized because it is at a federal level, and it's therefore very easy to know what your disclosure regime will be, how it will be enforced. I think investors feel very comfortable with how all of that will work out for them, and that predictability and comfort makes it makes it much easier for people to invest and move away from savings. I think I saw a stat, and I'm not even sure if it's out of date now, but that something like US households have over 40% of their assets in equities, and compared to the EU, it's somewhere between 10 and 12 or something like that, depending on where you are. And that's significant. And I think a lot of that comes from, and people talk about culture, but I think the culture is bred from the framework. There is a much more comfortable risk mentality, and I think that comes from having a harmonized regime. That's sort of one big feature that I think is more tricky in the EU, but is something that the SIU and the CMU before that has focused on as something that needs to be addressed, and I think would be a significant move forward for the EU. And then I think, not to harp on Prudential, but that is my background. There is a sort of, when you trap capital and you perhaps have buffers that aren't usable, they're really just capital that are kind of trapped and unused, and they could be redeployed into the market and used for lending, as we have seen in the US. Those kind of issues, I think, are what constrains EU markets, and I've just talked a bit about the retail side, but also kind of broader investment by corporates and tech. If you want those things to stay, they need to be funded. So if you want growth, I think you have to think about all of those factors.
Thank you very much. I have another round of questions I want to pose, but I thought maybe we take a break here and open for audience questions and comments. So if you want to share a question or a comment, please raise your hand and we will bring you a microphone. Anybody? Especially interested if there's anyone here from the EU Parliament and or the Commission. It would be great to get some direct policy voices. Not a one. Okay, then we'll just, if you're dreaming about the coffee, you're still going to have to wait. So then let me ask all of you to tell me your single top priority, essentially the question that David put to Colm and Jörg at the end of that discussion. If you could delete or rewrite one specific piece of EU financial regulation tomorrow to instantly unlock investment and create the kind of dynamism that we're talking about, what would it be? I'll start down here with Diane.
It would probably be the BRD in order to align the requirements that are set on European banks with global standards more closely, so the MREL and TLAC requirements.
Okay. Christoph König?
This is a difficult one. There are many.
Then you can have two or three.
I take one that is just also on the top of Swiss banks. That's certainly CRD6, Article 21. Just one that is still banks are struggling with understanding what the reasons behind is for excluding third country banks to provide banking services not aligned to what other third country provisions actually provided. So just to engage in a fruitful dialogue with anyone, with regulators also at the level of the ECB or EBA, I think that would be worthwhile just looking at it. Actually, what kind of untapped investments could be made possible if rewriting this article would be something that is at the table.
Mm-hmm.
From the Swiss perspective, also CRD6 right now, which is, as we've just said, making the market access even more complicated. But from a broader angle, because we all have the same interest in having deeper, broader capital markets in Europe, the single most important part is the simplification. And the good news is AI is here, so I would strongly suggest we throw all those texts in with a few prompts. I'd be very interested to see what comes out, you know, what is actually essential to make sure that, you know, the capital markets are safe, that we've got consumer protection, that we respect the sovereignty of Europe, etc. But please, in as few words as possible. And I think we'd go a long way, and that would be a neutral arbiter and not just one country defining. So that would be my own dream.
And Sam, from that double outside perspective, both the perspective of someone who's looking at this from the US currently, but also from as a UK national, what would you say?
Yeah. So I guess I would also, support a rethink of 21C. That from the outside bank perspective, that's very complicated, quite costly, and it isn't quite clear to me what it benefits, other than harder, more expensive access for EU clients and investors. But outside of that, I think we have EU members too. I think it's really important for, and not a collective sigh, please, but for people to really step back and think about the capital framework. And I appreciate that's very broad, so just to give a couple of concrete examples, and I've touched on one, I think the Pillar 2 guidance, I think that is sort of limited transparency, unpredictable. I think it would benefit from a clearer sort of appeals process. I think that sort of is a key factor that's sort of opaque, bringing into the light a lot of these capital framework issues for people to see if they work and establish whether or not they actually help or hinder. And then the second, I think, is sort of buffer usability. For me, there's so many buffers, and this is something the ECB has already picked up on absolutely correctly, that it's complicated. There's overlaps between the different pillars. The buffers themselves are supposed to be used in stress, but actually, if you get close to that, there is a potential for being penalized, so people don't want to do it. And if you have buffers that are not used in the times when they're meant to be used, they're just trapped capital that could be deployed differently. And I think that's fundamental for growth investment.
Dan, I see you nodding at that.
Yeah, no, I mean, like I said earlier, I think there is this issue of, essentially capital being trapped unnecessarily. And as we heard in the first panel, maybe the fact that we've gone beyond what was necessary after the great financial crisis, and at the same time now we are, trying to strike a balance between not going back to the previous regime, which certainly was insufficient, and not being too liberal, at the same time as the geopolitical context is completely changing. So I think there's also one element that we need to take into account here.
Thank you very much. Just going to look out to the audience one more time. We have a little bit of time. Anybody? Okay, please.
Thank you. Fiona Wright from Flint Global. I had a question for the panel about who, in terms of stakeholders, do you see as the appropriate instigator to kind of own and drive forward this reform process? Because I would argue you've seen the Commission give a good try under von der Leyen too, but there's been issues with kind of institutional design, incentives are baked in, it's very difficult to deliver and execute on change ideas in this town. So I was very interested to hear from the panel as to whether they have an idea about how this could actually work in practice. Thank you.
Anybody? This is where we need our politician.
Yeah.
Can we just say the Parliament then? He's not here to defend himself.
Diane, do you have thoughts on that? Because you talked about the structural challenges.
Yeah, I mean, it's definitely not an easy question, so I don't have, unfortunately, the magic stick here to tell you what to do. I think there are some efforts that are being made by the institutions to try and, involve the various actors, and not only stakeholders, but also even academics and so on, with, consultations and dialogues and so on. But sometimes I wonder, to what extent both the format and also those involved are really using those channels, those communication channels, in such a way that is really productive. So sometimes what I witness, and that's me from an outside perspective, from an academic, is that it's also just an exercise of sharing views, as opposed to also being able to listen to what the other party has to say. And I think that applies on both ends. So perhaps one way to try and make this more efficient would be to try to have a real dialogue, and on both sides, but I recognize that it's perhaps wishful thinking.
Thank you. Anybody else want to weigh in?
I mean, if we take that as being broadly a change management, right? If we want to really change the way Europe is regulated at the moment, any change management tells you that you have to have the acceptance on the broad scale, and coming from the top in particular. So the top being probably shared between here in Brussels and the top of the country politicians. And Jörg said before, it would be so great to have one pension fund reform adopted and pushed forward jointly by France and Germany. Well, this type of stuff would be clearly a change management from the top, one of the top. So it's for sure that it needs a broad advocacy, a broad endorsement, and leadership actually from the top. So it's for the EU to find which best stop it is to show the way forward. But it's needed, otherwise nothing ever changes. And that is already at the scale of a company. If you have to make a change, if no one shows the way, no one makes sure that it's adopted and endorsed, the change does not happen. And by the way, I mentioned AI, same story, right? That is also change management. in companies, government regulation, wherever you want to look at.
Just because you mentioned Germany and France collaborating once again, and in fact in January we heard the finance ministers of Germany and France saying they do now want to work together in an E6 format with the 6 biggest economies within the EU. Would you expect that they can drive that kind of change? They've had lots of differences amongst these member states on a number of issues that are crucial to financial sector regulation, but maybe mindsets are changing now.
Yeah, I can only hope. I think it would be mutually beneficial. I think it's a typical example of the prisoner's dilemma, right? In economics, it's just everyone would benefit, but we just can't move because you can't align all the pieces at the same time so that everybody can actually grasp the benefit at the same time. And so you're always stuck in, if I give you that, actually will you give me that, but then I give you that. But it is really a prisoner's dilemma. So it's, in any case, my belief that there's something to be won for everyone there.
And Sam, I want to give you a chance also to respond to that question that was posed, perhaps also with a brief mention of the European Central Bank's role, because in the first fireside chat, it was suggested that perhaps the bank doesn't always have quite the dynamic perspective, let's say, the Fed might have in terms of also supervision, but other aspects of financial regulation as well.
Yeah, I mean, I was just thinking as we were talking about this, it's all coming around to a sort of a very tangential point, which was covered in the first panel in some detail, that actually perhaps a competition and growth objective for the ECB would not be a bad thing. You know, it would be an extra layer of accountability, something they have to take into account, that the Parliament would then challenge and question. And, you know, this goes back to some structural issues that Diane raised earlier on. Perhaps there's more structural reform needed, but these seem like they would get you to the right place. I think the UK has introduced that, seems to have had some success. I mean, it's still relatively new in the grand scheme of things. The US obviously has, you know, a sort of much closer alignment to from its policy to its regulation. Like, does its regulation activate its policy? Does it hinder policy? I think there's a sort of question there for, you know, EU. Does the ECB need that level as well? Something to kind of make it think outside of rule making in the supervisory space.
Thank you. Do I have any other questions in the audience? Over here and over here. Great.
Hello, thank you everyone. Michelle Chang from the College of Europe. So a few moments ago, everybody had said what they would like to go and focus on if they could. So I heard about, you know, L1 versus L2 versus L3, about Pillar 2, the CRD4, the BRRD4. What would it take to get there, and how difficult do you think it is at the moment? Does this need new legislation? Does this need to be part of the omnibus of simplification? Could it be handled within the existing governance framework?
Thank you. Again, we're missing Andreas Schwab very badly, but let me ask others to just jump in.
I guess I think it's probably different depending on the different issues. I think probably changing the framework, the structural framework, is a much bigger ask. So some of the things that we were talking about around accountability and structural reform, some of that I think is probably a treaty change, or I'm no expert, Diane. maybe not. No. You know, whereas some of these are, I think, compactable into an omnibus, but the omnibus has to move at pace, has to actually deliver change. It can't, you know, the benefits can't be sort of negotiated away through the process, which does sometimes happen. And I think that's where you would see real sort of tangible moves.
Diane?
Yeah, I mean, the short answer to your question is a crisis. Realistically, I think that's what we would likely need for things to really move forward. If we're talking about improvements and not significant, overhaul of the whole system, I do think that we could have, reforms and improvements without a treaty change. Definitely. I mean, I think nothing prevents us from, I mentioned earlier accountability, enhancing accountability channels, or changing the structure that we have with so many agencies. I mean, I didn't mention AMLA earlier, but that's the one that comes on top and follows a completely different logic and has a million things to do and no means to do so, if I exaggerate a little bit. So I think these kind of things could be changed. I think we could potentially merge some of these functions or rethink the divide of competencies between the national and the EU level with a view to making the EU level more effective. So I think, Michel, long answer, political will, short answer, crisis.
I had a question over here as well.
I unfortunately had a very similar question, but perhaps, so there's already been a lot of talk about level 2 and the very human, way of these delegations. You have late night negotiations and trilogues and you can't get along, so you say, okay, we delegate it to the ESAs to work this out. And it is, of course, a very negative thing. I'm very frustrated sometimes when I see these things slip into the negotiations, but I'm also asking, if you abstain from mandating these level 2 things in negotiations, won't you also come to perhaps regulation that is of lower quality, made with less expertise, where you have a push to come to very concrete figures in late night negotiations that might perhaps also lead to other unintended consequences? So that is a bit of my question. How do you see this? Because I, too, am often very frustrated about level 2, but perhaps there's also quite a good amount of value in those allegations.
Thank you. Diane?
Yeah, Simon, thanks a lot for the question. I think there is also the question of flexibility, right? I mean, you also want to have delegation and to level 2 so that you will have enough flexibility at a later point, and because it's easier to come to an agreement than it is at level 1. So I definitely see the added value of that. At the same time, I'm not sure the amount of level 2 mandates that we currently have at the EU level is commensurate to the resources that these agencies have. If you look at how much those agencies have on their plate, and at the same time the resources that they have, I'm not sure they can really deliver. So perhaps we need to live with the fact that we have so many level 2 mandates, but at the same time we would need to reinforce those agencies, both in terms of the actual resources that they have to function, in terms of the remedies, thinking here about administrative remedies in front of boards of appeal and so on, and also democratic accountability, like I mentioned earlier.
Thank you. Does anybody else want to weigh in?
I would like to make one point. Just if you refer to authorities that actually have in the mandate to supervise the stability and integrity of the system, that's their core. They can't think otherwise. They need to look at it from a perspective of how could banks or financial intermediaries best mitigate the risks. They don't have anything else on their mind. So there needs to be maybe not an accountability by them. However, the ones that are delegating actually to them should be well aware of delegating that to somebody who has only that as a mandate. However, then introducing a competitiveness mandate would maybe not actually do justice, because they do look at stability and integrity. That still is the core of having a framework that provides stability. So there needs to be another mechanism to reevaluate and review what they come up with in terms of competitiveness. And that's ultimately a political decision then.
Thank you. We'd have time for one last one, if anybody has. Yeah, here we are.
Hello, Kristina Budrita, FTI Consulting. I have a question maybe to the academia and to Swiss. Technically, at this point in time, European Parliament does not have something that forbid them to do some parliamentary scrutiny over what the European supervisory authorities are actually doing, right? But there is no sexiness in this. There is no interest in doing this so much publicly. So I wonder whether this is different in Switzerland and how we can bring that attention.
Thank you very much. Thinking about Switzerland as being especially sexy. Crystal.
So yet still the nirvana, so it's yet to come. Actually, they have increased the scrutiny about what is being conducted and done by regulators. It also is quite tricky for them because the kind of level of expertise that is needed for parliamentarians to really evaluate the risk and what is involved in it is also tricky. So it needs staffing. They really need to understand the issue. I think we are not there yet, but they also look at it much more closely and having a rather principles-based level 1 approach to it. So they do give great value on the main risks that are involved, and they do have deliberation on that in Parliament.
Other thoughts on that? No. Okay, then I think we will draw a line there and say thank you very, very much to our panel for sharing their insights.
Thanks.
You've given us a lot to think about, and we're going to pick up on a number of points that you've made when we now, after the break, talk about the role of Savings and Investment Union in trying to get that those savings out of people's mattresses and into equity markets, and thereby indeed create the investment channels and pools that we need to make Europe more competitive. So thank you very much to all of you. And thank you also to the audience for your attention and for your participation, your questions. We do now go to that coffee break. It's right over here. You will find refreshments in that room. And then afterward, we meet back here, please, at 4:30 to continue with our panel on SIU. Thank you.
Ladies and gentlemen, welcome back. We hope you all had a refreshing break. And talking about refreshments, I should remind you that after the conference at 6 o'clock to this side, in the other room, there will be a reception held. So do stay with us, not only for the content, but also for the drinks. I think that will be a lot of fun, and looking forward to seeing you there as well. And for now, we continue with the program, and it is my big pleasure to introduce our today's keynote speaker, Mark Branson, president of BaFin. I think he's very well known to our Swiss and European audience. Mark Branson has led the German Federal Financial Supervisory Authority since August 21. Before taking this role, he spent more than 7 years as the CEO of the Swiss Financial Market Supervisory Authority, FINMA. And alongside his current executive role, Mark is a member of the Financial Stability Board, the German Financial Stability Committee. He also holds a seat, obviously, on the Supervisory Board of the SSM and is a member of the European Systemic Risk Board. Today, he'll speak to us about how we can turn ambition into action in Europe's capital markets, a very timely topic. And yeah, Mark, it's a pleasure to have you with us. The floor is yours. Thank you very much.
So thank you, Esther. Thank you, colleagues, for the invitation to be here today. It's a pleasure to be here in this conference, which I think has been running for several years now as a way of bringing Switzerland to Europe and Europe's decision makers in contact with what's driving the Swiss financial sector. I always found that a great idea. To talk with each other rather than about each other. So I'm very happy to be here today. And in preparing for what I wanted to say, I was sort of thinking back high level about what are the basic political ideas that underpin the way the European Union works and the way Switzerland works, and you can distill that, if you like, in the official mottos of the jurisdictions, because there are various mottos that express, the founding ideas of jurisdictions that have a lot of similarity. In Switzerland, you can see it, I think, sort of written in the ceiling of the Parliament building: unus pro omnibus, omnes pro uno, one for all for one. So a little bit musketeer, like this idea that from the diversity within the country you create strength. And of course, in the EU, the motto that underpins the way the EU functions is united in diversity. There's even a Latin version, but I think that's a little bit fake, because Latin obviously is not one of the many languages that are used officially within the EU. Even if you look at the United States, you can read on every dollar bill the basic idea of the United States of America, e pluribus unum, meaning out of diversity, unity, something that's got a little bit forgotten in the United States in recent times. But you have these basic political concepts, these mottos that are essentially expressing two core principles. On the one hand, unity, solidarity, collective strength, and on the other hand, plurality, diversity, and subsidiarity. And within the EU, obviously, we spend a huge amount of time navigating the tensions between these two principles. And that applies equally to the financial markets and the way they are regulated and legislated for. Against that backdrop, we've been discussing for years now the question of how best to foster European competitiveness, innovation, economic sovereignty, and coming back to today's topic, the importance of deep capital markets in facilitating this. We all know that if the motto of the EU is united in diversity, Europe's capital markets are more diverse than they are united. We also know that the awareness of the need to change this is here. The will to move forward is here, and has been here for a while. But if we're honest, and I see David Wright sitting here, he invites me every time to Eurofi to sit on a panel about the Capital Markets Union, where for years the questions have been the same and the answers have been the same. Right? Do we need to do something? Yes. What have we achieved? Not very much. What do we need to do? Well, there's a list. So what's new? Do we have a chance in Europe of making something more united out of these diverse and fragmented capital markets? Do we have some momentum to move forward faster? Obviously, the external pressure to do so has intensified, and that, as we all know, and I think, yeah, yeah. The external pressure has intensified, and as we all know, and I think if you look at the history of Switzerland's political development, it's sometimes external pressure that drives necessary reform faster than internal pressure, and it's clear what has been happening to the global environment around us. More confrontational, more fragmented, more volatile, deglobalizing steadily over the last decades, with the topics even close to home, like Brexit pulling Europe apart. So the world is deglobalizing, and in this kind of confrontational, more multipolar, more deglobalized world, Europe has to define itself based on its strengths and building on its strengths, and not just in relation to others. And one of those potential strengths and untapped opportunities is the European capital market. A more efficient capital market means more efficient distribution of capital. It means getting the funds that there are in the European system to flow to the places where they can be used most productively and they can contribute the most to effective economic growth that we know from the theory. What we need to get there are lower costs and higher liquidity. And what we also need is investor trust, created through transparency, legal certainty, smart regulation, and stringent supervision. So what does that mean for the current state of play in trying to unite those capital markets? We have got a rebranded capital markets union, now savings and investment union, with more momentum behind it, and legislative initiatives which have a higher ambition level than we've had in the past. And I think we welcome that from a German perspective, from a perspective of my organization. We welcome that ambition. We feel that the direction is right and the ambition level is refreshing. But if we look back, the problem hasn't been the ambition level, it's been implementation. So what we need to do now is get out of the conceptual world and into the world of delivery. And that means a certain amount of pragmatism, moving forward with steps that can consensually be reached that make sense, and not getting entangled in too many intellectual debates. What we have to do at the same time is not, of course, have a firm eye on financial stability and the risks in the system, but also have a look at what's happening to the administrative burden for financial market players. And so if we focus that down on the various aspects that are relevant for capital markets, and first focusing on regulation and supervision. Our view, my view, having worked at the core of Europe's financial markets now for the last 5 years and previously observed that as a partner from outside, is that the European system has a problem with the efficiency and the density of its regulation. What we need to do is make the regulatory setup more efficient without lowering the level of security that we have built into the system. And we need to reduce complexity. Here, I think, is one of the areas where the EU can learn from how Switzerland, with an important financial sector, has solved the same challenges with an enormously lower density and page count of regulation. If you look at what the MiFID II package, if you like, what weighs on when you put it on the scales, and the core of investor protection legislation for Europe's capital markets, nobody quite knows. It's almost impossible to count, but you can see estimates of around 30,000 pages of text and 1.5 million or 1.4 million paragraphs. And if you look at the way that's been done in Switzerland, the primary legislation is 36 pages, and the supplementary ordinance is 126 pages. Of course, these are slightly facile comparisons. But the two pieces of legislation are deemed equivalent with one another, which means that they are deemed to be reaching the same goals. And if you can reach a goal with hundreds of pages, why would you want to reach it with tens of thousands? And I think there we have to have a long, hard think about the philosophy of European regulation, the philosophy of interminable codification, if you like, and also about the process which is generating not just primary legislation, but a lot of technical standards through the supervisory agencies which are accompanying that primary legislation. This is not in any way a new observation, but if we're thinking about how to make our markets more effective, we also have to think about how to make our regulation more fit for purpose. And obviously, if you're more principle-based, that puts more responsibility on financial institutions. It puts more responsibility on supervisory judgment to be an adequate filler of the gap that is left by the missing pages, if you like, in the rule book. But codification cannot ever be the answer to all of the problems. And we, together with financial market actors, have to get out of the mechanism, out of the mode of having the feeling that life's just a little bit better with a Q and A, because you have that sense of security that nothing can go wrong. If you've asked the Q, you've got the A, and the Q and A is there for all to see. We've created a rule book which is simply too big. What I would also say on regulation is that greater efficiency of regulation means hitting the right goal with your regulation with a proportionate approach, that regulation and supervision has to be appropriate for institutions of different sizes and shapes. We do have a mentality of taking the single rule book as something which doesn't just apply geographically across all jurisdictions in Europe, but has a tendency to apply in a very similar way to all types and shapes and sizes of institutions. And I think if we turn our attention to banking for a second rather than capital markets, we've got an example, again, in Switzerland of a small banking regime which was set up a few years ago, which has proven that you can reduce the complexity of the regulation for small institutions while at the same time increasing the amount of capital that they need to hold as an entry ticket, as an opt-in, which I think has been running successfully for several years now. And within Europe, together with our colleagues at the Bundesbank, we are propagating a similar approach, a separate, radically simpler regime for small banks who would be allowed to opt in if they hold more, maybe significantly more than the basic minimal level of capital. Just as an example, for a way you can get at simplification in a radical way without changing the level of security in the system. Because let's face it, that security that we have in the system and the resilience that we've built up over the last couple of decades in such an uncertain and risky world is something that we have profited from enormously over the last couple of decades, and that we shouldn't in any way question. So proportionate regulation doesn't mean lax regulation. We think there we can bring a new dynamic also into the regulatory process in Europe. If I turn from regulation to supervision and back to European capital markets, one of the very topical questions is how you organize supervision and the question of how much centralization would bring more benefit to the way European capital markets work. And it's a tricky question, but I'd like to spend a little time on it. Firstly, what we have to be clear is that the way you organize supervision is not going to drive the way markets develop. So if you if you centralize your supervisory infrastructure, that doesn't automatically make markets more liquid and deeper and more efficient. And it doesn't remove the other key obstacles that you have for the attractiveness of capital investment within the European Union. So we shouldn't have too many illusions that just changing supervisory structure, is the silver bullet. Having said that, I do believe that centralization can make a lot of sense if it's done in those areas where there are very significant risks at stake, and there's a good chance that it can be done more effectively and efficiently at a European level. I think the single supervisory mechanism, the SSM for large banks, was a step change that was necessary to raise the game in supervision where you have enormous systemic risks. I think if you apply that to the capital markets and you look at large clearing houses, you look at large international securities depositories, you have the same kind of setup. You have large international players with a systemic footprint. Why should they? What is the benefit of having them nationally supervised? As long as you sort out who's responsible for the costs in failure, I think centralizing supervision for these kind of large systemic players, makes a whole lot of sense. If markets are much more disaggregated, so if you take, for example, asset management, where you have hundreds of much smaller players, the case for centralization becomes more questionable. And we have to be honest and admit that the way we have Europeanized supervision in the past has always, thus far, been a high-cost exercise. We have gone down the route of adding a European layer without thinning the national layer, and obviously paying for the interface between the two layers. And I do think, having been part of this system now for a while, that this high-cost way of centralizing supervision is something we have to think again about. It may be a more coherent approach instead of merging the approaches of national and European layers and institutions and bringing them together, would be simply to drag and drop supervision for example, for clearing houses from the national level to the European level. Because it would be ironic if, in the name of market efficiency and low-cost markets, if we only succeed in creating ever more costly and more distant supervisory organizations. So I think we have to be careful about the way we centralize and not just talk about whether we should centralize. One thing I think which is absolutely crucial, which is that supervisory authorities cannot be allowed, in the name of attracting business, to offer more tolerant supervision as an attractive part of a package. And this is particularly relevant for companies with digital business models, with little direct contact with their customers, exploiting maybe differences in supervisory approach, and with a passport, damaging the integrity of the system, and maybe damaging the interests of consumers in another jurisdiction. That also obviously applies to services coming out of third-party jurisdictions into the EU, like in Switzerland. We need to have mechanisms that make sure that you have a uniformly high standard of supervision, and that can converge within, a tolerable range of approaches to deliver a security of a quality of outcome. And I think from our perspective within the EU, the three ESAs, the supervisory supranational authorities, should be in a position to intervene more strongly when they see divergent approaches to applying what is essentially the same rule book. So we would really welcome these ideas as part of the market integration package to strengthen their role as supervisors of supervisors. Summing up these thoughts about supervision, centralization would definitely make sense in some sectors. Some has already been done. Some will follow. It probably doesn't make sense in all sectors because the costs of centralization can't be allowed to exceed the benefits of centralization. And furthermore, supervisory structures don't create market structures. We have to also focus on market infrastructure, market processes, and legal reforms. Simplifying regulation, I talked about, is one of those reforms. And of course, there are other options that the policymakers now have on the table, and they will make their own decisions. But just a couple of things that I think are particularly important for the future of European capital markets, which lie outside the direct question of how you organize regulation and supervision. First, the creation of a corporate legal form in the EU, which is truly attractive for scaling up growth companies. Every time that you talk to people engaged in financing this sector, the innovative sector that wants to scale up and has a difficulty doing that in Europe, you come to this question of the legal form. We do have a European legal form, but it's rooted still in national diversity and isn't really suitable for small growth companies. And that is one of the reasons why we have this drain of innovation out of the European economy. This is difficult stuff, but we believe that if you go at that legal form question and create something 28th that is more suitable for smaller institutions, you would have a real effect. Secondly, for the capital markets, the depth of capital markets is partly a structure question, partly a supply question, partly also a demand question. And in vibrant and deep capital markets, a large part of the demand comes from retirement savings and pension provision. And we all know that many of the pension systems that we have in Europe are rooted in the past in terms of the way that they're set up. And unless we place more of our retirement savings in higher return investments, we have an issue with the depth of the market, we have an issue with the real economy, and we have an issue with our demographics. So obviously, very difficult to do, but I can't see a way to generating truly more vibrant capital markets without having a more capital market-oriented pension system. And third idea, that highly political and difficult to do, to get done, is the lack of uniformity in some of the key legal setups. And thinking about insolvency law, this is politically desperately difficult to get done, but with 27 different ways that companies fail, and how they are dealt with in failure creates a major obstacle for the harmonization of the way their securities are traded and settled. And so we believe that also not ignoring some of these very difficult and very fundamental questions about how to make out of 27 markets something more unified. If we don't do that, then we'll miss some of those opportunities. You know, one of the reasons why the US capital markets are so powerful, in the end, there's only one place where you go to have your securities settled and custodied, and in Europe you have 27, and that's not because you want 27, it's because the legal frameworks push it in that direction. And if you have that as a starting point, then you're always going to have markets that are more costly than they need to be to operate. So, concluding, the global environment that we have has to push Europe to build on its strengths. It has to push Europe to think about how, out of the diversity that we have, to create more common strengths, to do that in a pragmatic way that is focused on what can be implemented. With a view to the goal of a more efficient capital market, which is going to have an impact on prosperity and employment. And I think the success, the degree of success that we will have, as I said at the beginning, it's not based on the cleverness of the concept, but it's based on the willingness to act, the willingness to turn some diversity into unity, and the will and therefore, yeah, jumping over sometimes our own shadow in the cause that is bigger than an individual national cause and is there to get Europe stronger in a difficult and uncertain world. Thank you very much for your attention.
To Mark Branson for those key messages and that resounding affirmation of the fact that SIU is an idea whose time has come or needs to have come. We'll pick up on a number of the points that were just made. And when it comes to the vitality of integrated capital markets, we want to be talking about not only integrating capital markets within the EU, but also how EU markets work together with Switzerland and the UK. So those are our key topics, and we have an absolutely outstanding roster of speakers to address them. Again, I'm going to keep the introductions on the short side in order to maximize our time for discussion. And I begin, I'll invite our panelists to the stage in the order in which I introduce you, and then please fill up the seats from this way over. So I start with Nick Dreckmann. He is Chief Operating Officer and Deputy CEO of the Swiss private bank Julius Baer, and he has been with the company for 20 years and recently announced that he will be stepping down in April. It's also, so please, Nick, join me here on the stage, and that will be your seat over there. Great to have you with us. It's also a pleasure to welcome Laurent Ramsey, and actually welcome back, I must say. He's been with us a number of times in the past at the SFC. He is managing partner at the Swiss multinational investment firm Pictet, and he also sits on the board of the Swiss Asset Management Association. Welcome to you, Laurent. Great to have you with us again. I'm also very pleased to welcome Björn Sibbern. He is CEO of the international financial market infrastructure company SIX, for whom he previously served as global head of exchanges. He has 20 years of experience in the capital markets, including a position at the NASDAQ. Welcome to you. Great to have you with us. And I am very pleased to welcome as well Philippe Till. He is member of the Cabinet of the EU Commissioner for Financial Services and Savings and Investment Union. He has responsibility for the portfolios, I should say the key portfolios for the topic we're discussing here: financial market literacy, retail financial services, market infrastructure, and investor protection. So welcome to you. Please join us. And finally, I'm very pleased to welcome William Wright. He's founder and managing director of the think tank New Financial, which was founded in 2014 and is dedicated to fostering bigger and better European capital markets and a reboot of UK markets. So welcome. That'll be your place right there. Thank you. So I'd like to start with an assessment of where things stand, and clearly we're covering ground that has been elaborated already in some of our previous discussions, but I'd like to get your take on this as well. And William, if I may begin with you, we've been talking about Capital Markets Union for over 10 years now, and of course CMU got, or hopefully got a reboot now with its new name, which it's had for the past year, SIU. The question is, when you look at the hard numbers, liquidity, IPOs, cross-border flows, and the gaps relative to the US, have we made any genuine progress in all this time?
Well, thank you, Melinda. Thank you to the Swiss Finance Council for the invitation. The short answer to that question is no. And the slightly longer answer to that question is we're roughly back where we started 10 years ago. So when you look at the size of capital markets across the EU relative to GDP, You look across 25 different sectors of activity, from pensions and asset management to debt markets, equity markets. And what you see is that today they are 2% bigger relative to GDP than they were in 2014 when I launched New Financial to make the case for bigger and better capital markets. So I've obviously still got some work to do. But they're 2% bigger relative to GDP than they were 10 years ago. If you look at the basic building blocks that you would like to see or expect to see from a successful capital markets union, you're talking about bigger equity markets, more IPOs. Relative to GDP, IPOs are down 60%. You're talking about more corporate bonds, less bank lending, or the shift in the balance between the two. Corporate bonds are down 20% relative to GDP, and the balance between corporate bonds and bank lending it's moved a few percentage points, but hardly at all. You look at the reliance of EU savers on bank deposits. It's exactly the same today as a percentage of their household financial assets as it was 10 years ago. In fact, the only significant area where we've seen significant growth, which is hugely welcome, is in private markets, mainly in and around venture capital, where in real terms, relative to GDP, we've seen an expansion of four times the volume of investment today, which is fantastic. But broadly speaking, for all the noise, for all the debates, for all of the legislation and new regulations, we're back where we started.
Thank you. I'll jump over to Laurent, if I may. And we often hear that European asset management, the market is inefficient compared to the US. We have thousands of small funds here in Europe rather than deep pools of capital. And the average fund size in Europe is a fraction of the size in the US. Is that fragmentation purely a result of client demand, or are there other factors at work?
No, I think there are other factors at work. I think you're right in stating the difference in number of funds. I think some estimates say that we have twice the number of funds in Europe than we have in the US, and the size is anything between a fifth and a tenth in terms of the average size of funds in Europe versus the US. But I think it comes down to three things. The first one has been talked about, is perhaps the size of the occupational pension market, which is a bit short of 30% of GDP in Europe. It's, I think, around 140% of GDP in the US, and close to 160% of GDP in Switzerland. So unless we have a well-functioning and global European occupational pension market, it's going to be very difficult to have a pie which is big enough to have an average fund size which is bigger. The second problem is that not only we have a small pie, but the pie which is allocated towards equities is small. I think Christelle mentioned it, that equity adoption in Europe is 15%, I think 18% in Switzerland, and I think you said 55% in the US. So the amount of money from that smaller pie allocated to equities is small. And then once you allocate to equities, you have this plethora of products between cross-border products and 27 domestic, member states products. And they all have a justification to exist. First, it's difficult to merge them. And second, because of language, because of different tax treatments, because of different disclosure, we still have an incentive, if you're a domestic player, to have a domestic product. And therefore, if you put these three layers, one on top of the other, it leads to much more fragmentation in the European market. So I think the first step, number one, is to try to get a pension reform that works. Step two is to try to get an equity culture through education or through incentivization to invest in equities. Step three is to try to then make it easier to merge fund cross-border in Europe.
I want to come back to some of those points shortly. I'm going to go to Philippe now to talk about the fragmentation side of this, because we've heard a lot about fragmentation throughout the course of the afternoon. And in fact, at the end of last year, Commissioner Albuquerque made a proposal, quite an ambitious proposal, to reduce financial market fragmentation in Europe. I'm referring to MISP, the Market Integration and Supervision Package. Previous attempts to do this, we must admit, have hit a wall. So is this time different?
No, thank you. I think I want to start by saying maybe starting on a more positive note. I think the measures that we've taken over the last years, there's a comprehensive set of measures that have been taken in different areas. And I want to say we have really laid out the groundwork for what we're now trying to do under this mandate. I want to say we've put in place a lot of important bases, and we've also learned a lot of important lessons over those years about what works and what does not work, and we can now build on that to take things forward and to improve the framework where we've seen that it hasn't delivered what we have expected. In terms of why I'm optimistic that we can make, I think, decisive and ambitious progress this time around, I think there's two factors that I want to point to. The first one is really the political buy-in, the political backing. There's been a sense of realization that having more dynamic capital markets and having an SIU is a core pillar of European competitiveness. And so wherever there's a discussion about competitiveness, there's also a discussion about completing the SIU. And I think that that's something that is changing. It's up to us to channel that political urgency and deliver concrete results. The second factor that I want to point to is really the approach that we're taking, which I think is also something new compared to previous years. And I say that in two regards. I think the first one is we're taking a more collaborative approach where we've realized that the SIU, we're not going to deliver that only top-down. There's also a bottom-up effort, a collaborative effort by every actor in the system that's required to really make progress. And there's a lot of measures that member states can take themselves to advance on this area. And I think it means that they also can't hide behind the EU anymore to the same extent, and there's no excuse for not delivering what is needed to advance. The second point I want to point to is the very comprehensive approach that we're taking, because we're using every tool in the book. We are using regulation, as you mentioned, with this package, with a number of other packages on securitizations, on pensions that we've already put forward. But we're also using non-regulatory tools, be it recommendations, and very important recommendations, I want to say again, in the area of pensions and savings and investment accounts. And we're also using other processes like the European semester, and we're willing to support efforts by member states that want to go further, like we've seen in the competitiveness lab. So we're really having a very comprehensive approach to this, because it is a very comprehensive problem.
You mentioned recognition that SIU is crucial to mobilize investment in order to drive competitiveness. At the same time, as we know, fragmentation has been very much about the fact that so many member states, when it comes to the crunch, don't want to give up key areas of national control. Do you really think that is now changing?
I believe it's about explaining what this project is about, understanding where the concerns may come from, and demonstrating that by taking the measures that we are recommending, everybody can be better off. And it's not about them against us, it's about collectively doing more and being better off.
Thank you. Björn, as an exchange and financial market infrastructure operator, you have an inside view of financial market plumbing. So in Europe, trades often go through multiple national clearing and settlement systems. To what degree does that add costs compared to the way that the system functions, say, in the US? And do you think that the Commission's current proposals can actually begin to address these inefficiencies?
So first of all, great to be here, and thanks for the invitation. And sorry, I might sidetrack us a little bit, but listening to the data we got from William, we have wasted 10 plus years, right? I've been a part of these panels for so many years where we have discussed exactly the same. 10 years, and we're still discussing the same parts, which is concerning. But let me at least try to address some of the things that we need to do. And then I'll get back to the plumbing part. So I was a part of the plumbing when I was running Nasdaq's exchanges in the Nordics. And you always have to be careful when you sit on a panel and claim you're an expert. But the Swedish model, I was actually a part of building. And 15, 20 years ago, there was a big discussion in Sweden saying, we do not need the exchanges, there are no listings. But what happened in Sweden was, there was a political will. And that's what we are missing here on EU level. There was a strong political will saying, let's use the equity market as a part of financing the many, many great small cap companies we have in Sweden. We have that on EU level as well. We have that in Switzerland. We have the many companies, we have the brains, but we do not have the venture capital to sponsor these SME companies. What happened in Sweden then? The government put together the industry, pension firms, advisors, banks, online brokers, and they built the Swedish equity model, the one that everybody talks about. So if you shouldn't look at solutions, I fully agree, we need a pension reform. But the solution around retail activation that we talk about, and when we compare us to US, where it's probably 3 times higher than what we see in Europe, there's a solution. And it has worked for 15 years in Sweden. Sweden lists more SME companies than any other exchange in Europe. Spain, we run the Spanish exchange, by the way. We have also found a model in Spain. We are getting there. But the model is actually out there. It's just a question about political will to execute and implement it, because the model exists. In some of the other Nordic countries, I'm Danish. I tried to implement it in Denmark back in the days, but the political will was not there, and they implemented half of the solution, and it does not work. So it's only a question about political will and getting it done. And I would hope that the urgency is here now, because we cannot afford to wait even longer. One thing I want to say is there is actually, yes, we talk about fragmentation, and fragmentation is a challenge in Europe. With that said, there are many things that has actually improved. So if you look at equity trading, you can trade on MTFs. We acquired one in UK where we trade and compete with ourselves in Spain and Switzerland by 16 markets across Europe. It works super well. So on equity trading, on the trading side, there's competition and there's fee pressure, and we love that competition. When it comes to cash clearing, we also run a clearinghouse in Switzerland that on cash clearing where we compete with a handful of other cash clearing providers where the fees are super low. So part of Europe is actually getting better, but there are still areas where we see lack of activation and lack of urgency. And the plumbing, a big part of the plumbing is already there, just in front of us. We just need to have the political will and industry support to do it.
Thank you very much. Did I sense that you wanted to jump in there?
Very briefly. I mean, completely agree with Björn that it's about political will. And I feel bad because I kicked off on a really pessimistic, on what could be interpreted as a really downbeat, pessimistic note. The one thing that I would say in the 12 years that I've been writing a lot about Capital Markets Union is that there is a shift. There has been, particularly in the last 2 or 3 years, a very discernible, very clear shift in the political will, the recognition that this is no longer a sort of nice-to-have project that nobody, frankly, really understood 10 years ago. This is a fundamental part of reforming the EU economy for the benefit, not just to play catch-up with the US, but for the benefit of hundreds of millions of its citizens. And that progress, and the progress in the quality of the debate, and we're really now beginning to zoom in the last couple of years on the levers that will make a difference. It's what national member states can pull, not just what can be done at a Commission level, at an EU level. It's what the EU, what the Commission can do to help, rather than just to tell. So there is significant progress. It's just not yet showing up in terms of most market outcomes.
Thank you very much. Let me go back to Laurent for a perspective on the contrast between the US and Europe and Switzerland. So we've heard a number of times today about the glaring fact that so much capital leaves Europe for the US, and that IPOs, for example, mostly happen in the US. The home bias in Switzerland amongst asset managers is actually quite strong. Swiss funds tend to invest, or often do invest, in Swiss equities. What accounts for that, would you say? And will the Commission's current efforts to reduce barriers to cross-border investment, for example, actually make a difference, do you think, in terms of flight of capital?
Okay, so two parts to your question. Perhaps the first one about Switzerland. I think Switzerland is a special case. I think for a start, we have a very strong currency, zero interest rates. So therefore, the risk and the cost of investing abroad is pretty high, because whatever you make on the market, you might lose on the currency, and if you want to hedge it, it's costly. So de facto, the tendency, the hurdle to invest abroad is higher just by that fact. Second, there are some tax advantages. If you are a Swiss domicile fund investing in Swiss equities, you can reclaim 100% of the withholding tax. It's not the case if you are in a foreign domicile funds. And last but not least, as I said before, we have a relatively large, pension system relative to our GDP. We need to match our investments to our liabilities, and therefore there is a home bias which is inherent into that part of the market. So I think these are structural differences when you look at Switzerland versus Europe or the US. Now, to the second part of your question, I think a lot of the work and a lot of the things that we hear are about how to make investments in Europe easier, simpler, more efficient. And here I'm talking mainly about equities. But at the risk of being a bit provocative, if you can invest more in a worse company, if you can invest in an easier way in a bad company, would you invest in that bad company? I'm not sure you would. And I'm not saying in Europe there are bad companies. I'm saying that the key is the competitiveness of corporate Europe. And unless we fix that, we can have all the plumbing right. Money is not going to flow back into Europe. Money knows no boundaries, and therefore money follows opportunities. So we need to create an environment in Europe where companies can thrive and be competitive globally. Mm-hmm. So that I would say is the most important thing for Europe to get right.
Thank you very much for that.
And I would say something else. We heard also a lot, and that's very important because the trick for Europe is not to find a way to keep European savings in Europe. The bigger price is to attract foreign savings into Europe, right? That's the big price. That's what the US have managed to do. Foreign capital going into the US equity market or the treasury market is massive, all right? This is what we need to achieve. On top of that, we have a product which is called UCITS, which is one of the only wrapper which has a global reach. You can sell it in the Middle East, you can sell it in Latin America, you can sell it in Asia. So you have the wrapper. You just need now to make Europe a competitive investment proposition.
Thank you very much. Let us now talk a little bit, dive deeper on solutions to some of the problems that have been identified both here and throughout the afternoon, and also with a focus on Swiss-EU cooperation. So I'll go to Nick. Thank you for waiting patiently over there. The EU, as we've discussed, aims to channel household savings into capital markets. Things like the MiFID investor classification are often cited as a key obstacle to that because they essentially make it difficult for high net worth individuals in the retail category. From a practitioner's perspective, how does that limit wealth managers' ability to move client assets around?
Yeah, thanks for the question, and maybe doubling down on what Laurent said at the very beginning. When it comes to product manufacturing and the 3 layers of complexity to produce for individual jurisdictions and client segments, MiFID looks at it from a client and from a distribution point of view. And as you rightly said, I think MiFID has been designed in a way to protect retail customers. Now, when it comes to wealth management, or wealth management clients with sometimes a higher risk tolerance on the back of higher assets, this does not always fit the rules. I give you concrete examples as we are operating onshore in Europe in many different countries, but as a matter of fact, every client by default is classified as a retail investor. So we need to convince the clients that they're actually not retail investors in order to allow them the full breadth and suite of our products and services. So when I look as a wealth manager at the issues that MiFID II, for example, poses, then I would identify 3 areas. The first one is the suitability. So I need to basically prove that certain investments are suitable for our clients. Second, I think it's the topic of knowledge and experience. I need to prove that the client where I, for example, offer a private markets investment is suitable and knows what the risks are associated with it. And maybe the last point here is if I want to switch a client classification, it's quite an administrative burden to prove and make sure, you know, these kind of switches are actually happening. So I think these are small little pieces, I would almost say low-hanging fruits, when it comes to the administrative way of implementing MiFID II for a wealth manager where the client segment is not necessarily a retail client.
Mm-hmm. Let me ask you a follow-up question focusing on the role that the Swiss financial industry can play here in supporting especially the Savings and Investment Union. So how do you see the potential for a tool like the institution-specific market access approach that has been developed by the Swiss banking and asset management industry to lower investment barriers vis-a-vis Europe?
So now we're switching, right? Before I was answering from an onshore European point of view. Now we're looking from an offshore point of view, and I think it's no secret Switzerland is the biggest offshore center when it comes to offshore funds. And I think there is a significant amount of European clients banking in Switzerland. Right now, unfortunately, the way legislation and the rules are set up is that we need to work from what is called a reverse solicitation point of view. That means concretely, the bank is at the receiving end. We need to wait until a client from a European country is actually calling up the bank and asking specifically where or what to invest in. And the bank is only allowed to answer these questions once the call comes, and secondly, to only answer the question irrespective of how it is asked. So these are, I would say, hindering aspects to deploy the full cross-border, potential that we have in Switzerland to also channel funds back into the European Union in order to support these kind of political agendas and the savings union or the capital markets union.
You're essentially not in a position to be proactive.
Correct. And therefore, as we're trying to talk about potential solutions and answers to this, this idea of institutional specific market access approach, I think is something where, for example, individual Swiss players can basically apply the normal European rules, can be supervised for this particular business by European governance. And like this, there is a level playing field. And at the same time, then this offshore capital is being in a position to flow back, be that into private investments or be that into equity or particular European agenda items where capital can be deployed.
Thank you very much. I'll go to Björn, if I may, and looking at a different solution that the European Commission has introduced, the concept of pan-European market operators for cross-border exchanges that would operate across borders rather than nationally. So from your experience, would you say such operators can realistically create a single pool of liquidity? And are the proposed regulatory changes here, including on central supervision, helpful?
So first of all, we have to be careful. Central supervision we need to have that discussion. And I think it's an important discussion. I'm also a little bit concerned. When I look at the needs for retail investors in Spain, we run the exchange in Spain. We have Spanish regulators, and they ask us, what can we do to help strengthen the capital market in Spain? A little bit back to William's point, there is actually movement with some regulators thinking about what can we do to make the market more attractive. And it goes back to even Nick's point about have we all implemented MiFID in terms of retail protection. For listed company, we have hundreds of listed companies in Spain and Switzerland. Are we requiring too much when it comes to ESG reporting? So I think these questions start to pop up. But I have one concern with centralized supervision. I'm not sure who's the best to help Spanish companies, Spanish retail investors. Regulators sitting in Spain, close to us, understanding the local needs, or a central supervisor sitting out of Paris. We need to have that discussion. We need to make sure we do not do double work, do over-implement. So if I'm Vontobel, I have to actually deal with 2 regulators, or if I'm BNP, have to deal with a regulator in Paris and one more, the local regulator. We need to make sure that we do not do double reporting. So we need to have that discussion. I'm not against it, but we really have to be careful that we do not miss the local flavor that is so important. When it comes to fixed income trading, when it comes to ETFs, many of the needs are local needs, and taxation is still also local. So I'm a little bit concerned about centralizing everything with one supervisor, but we need to have discussion. As long as we design it right, I think there could be some positive spin on it, but we just have to be careful that we do not over-implement and do double regulation towards either with listed companies or towards banks or towards even online brokers that represented retail brokers as an example.
Thank you very much. William, in terms of the basket of solutions, let's come back now to the MISP, to the Market Integration and Supervision Package, and your view whether its provisions actually have the potential to make a difference. After your pessimistic early answer.
The early answers, to be clear, I don't think that was pessimistic. It was a statement of fact. It's where we are, and there are many reasons behind that. And I think the market integration package is representative of what I mentioned earlier about a shift in the quality of the debate. At various stages over the past 10 years, the debate has been very binary between should we have central supervision of markets, of everything, or should we have local? And with the market integration package, there's a recognition that in certain sectors where there is systemic risk, where there is already duplication, I won't reference your old firm, but Euronext operates 7 exchanges in 7 different member states, all of which are supervised by 7 different national supervisors. There is a recognition that actually maybe so long as the design is right and we're careful with the design, that it would perhaps make a difference. But I think we have to have, it echoes what Mark Branson was saying earlier. We've been arguing for many years, you cannot create a single capital market in Europe out of thin air simply by creating a central supervisor. And that has been the downside of some of the thinking at a European level over the past decade. And I think that's been one of the blockages as to why we are where we are. So I think, yes, it's progress. Yes, it's broadly sensible. I think it has the opportunity to unlock some more progress, but I think it comes with 2 dangers. First, supervision is such a politically sensitive topic. There is a danger that we're going to spend the next 5 years arguing about the wrong thing. And frankly, every day that we are arguing within the EU about the design of a central market supervisor, even if it's only for a segment of the market, is a day that member states are not thinking about, arguing about within themselves about more substantive issues like pensions reform, retail investment reform, and their tax system. So I think there is a danger of investing too much hope in the supervisory elements of the market interaction, but it's a sensible step forward.
Thank you. And Philippe, Let's broaden the perspective and talk about the role that Switzerland and the UK could play in all of this. When we talk about capital markets integration, of course, these days we're very, very focused on EU capital markets, but we have these two neighbors with a lot of experience and some good lessons learned for Europe.
No, thank you. I think the first point is we have immense investment needs, as have also been demonstrated by the various reports that have been issued over the past couple of years. So I would say there's a role for everyone to play in this. And we are very cognizant of the fact that successful capital markets need openness, because you need to have a chance for the capital to come in. You also need to give investors the perspective that they're able to sell off their investments to an attractive bidder whenever they decide that they want to move on. And I think part of what we're trying to do with the various measures, and certainly also with the market integration and supervision package, is overcoming that fragmentation that may be confusing for outside investors, and giving them a bit more clarity also on all the opportunities that European markets offer and what is really available across the EU, not just in the biggest markets, but in every single member state. That being said, I think we also, it doesn't mean that we don't want to have any kind of framing for that interaction. We need to, of course, be careful that we don't bring in vulnerabilities into the system. I think it's also fair in the current environment to say that we don't want to create any excessive dependencies. So we do need to frame that participation. And I think in that regard, the EU does have quite an interesting menu of different access options. Like we have, you can create an establishment, which is probably the broadest form where you can access, where you can benefit from the passport, where you have the biggest stability as well for your operations. But we also have various other access options depending on the sector, which allow you, which come with certain advantages and certain drawbacks as well. So I do think, in that sense, we are in a very positive place as Europe in terms of trying to bring outside investors in. And I think we've seen a development also over the past months, certainly, where we see some of that capital moving into Europe. Maybe this is also a chance to react on some of what William has said on the package and the focus on supervision. We do very much see that as a package, and there are certain measures that we are introducing that, of course, need to be compensated by certain evolutions in the supervisory architecture. So it's something that's linked together, and it's very difficult to separate one element or to do one measure that we would like to put forward without going the whole way, because whichever change we want to propose, there's going to be counter requests and there's going to be demands for balancing, and that's the balance that we've tried to strike with this package.
This is the famous trying to repair the jet's engine while it's flying, and many different parts are needing to be either replaced or augmented. Thank you very much. I think we could open for a few questions before we do one last round here in the panel. So who has a question over here? Here in the front row.
Hello, good afternoon. Susan Yavari, representing the European Fund and Asset Management industry. I'd like to pick up on a couple of things that the panelists have said this afternoon. I'll start with you, William, when you were lamenting how little capital markets have grown, looking at the key indicators in the last 10 years. And I can tell you what else we haven't had in the last 10 years, and that's a consolidated tape. And then picking up, Laurent, on your comments that really resonated, which was you were describing one prize is to keep European savings in Europe. The bigger prize is to bring a lot of that global flow into Europe. I couldn't agree more. And I think you'll find that we just published a paper today making those very arguments. So I feel like you could have lifted those out of our paper. So we are arguing for a consolidated tape. We very much support what the Commission has come forward with on the MISP, where you are enhancing the pre-trade data. So you're coming forward with value attribution, 5 layers. We fully support that, and we make the case in this paper, as I said. And I just want to say one last thing, and I'd love to hear also from our colleague from NASDAQ. I really don't think at this point we're talking about, or should be, in the market for revenue protection and kind of the short-sighted view on what the tape does or doesn't do. It should be about growing the pie, and all market participants have a stake in this, including the exchanges. So I really hope that that's kind of and you know, we talked about more collaboration and this shift, sort of the urgency coming forward. And you know, it may be a small thing, but it is important, and I really hope that the CT can be viewed in that way. Thank you.
Thank you. Björn, do you want to speak?
Yeah, happy to talk about the consolidated tape in Europe. So we support the idea of a consolidated tape in Europe. We are actually a part of a consortium with the other exchanges building the consolidated tape. So we look forward to have that solution in place. Just want to say the consolidated tape discussion have taken us probably 5 years. I'm just saying, again, we are wasting our time. We should have focused not on a consolidated tape, but discussing retail participation, not a consolidated tape. So I like the idea and I support it. I was, by the way, responsible for part of the consolidated tape when I worked for NASDAQ. And one of my good old colleagues, he just wrote a paper this morning saying why the consolidated tape in US does not work. So we have to sometimes be careful just not saying implementing, copying what is working in US, because Europe is different. But I think it will help with a consolidated tape. The main reason for me with a consolidated tape in a fragmented world is that if I'm UBS or if I'm Nestle, I want to see the total trading in my shares every day. That is difficult in such a fragmented setup we have in Europe. A consolidated tape will help with that. So I fully support the consolidated tape. We are part of building it. We look forward to it. But it will for sure not be the silver bullet that will solve retail participation or the problems we have with capital raising in Europe.
Thank you.
Very briefly on the consolidated tape, I completely agree that it's a great example of focusing on perhaps the wrong thing. I think right now it's a very sensible recommendation. Unfortunately, it's a perfect example of one of the themes running through today's conference, which is we've got these grown-up, sophisticated, deep capital markets and financial centers outside of the EU, either side of the EU, in the UK and in Switzerland. In the UK, it was our decision to leave, somewhat foolishly, arguably. We're going through our own debate on the design of our own consolidated tape. So we're going to be heading in the direction where the bulk of the market participants, the people making the orders, are the same people, and they're predominantly sitting in London. They're going through the same brokers and the same investment banks. They're routing through not dissimilar exchange operators, but we're going to have 2 separate designs implemented in different ways under slightly different regulations, introduced at different times. And it's a sort of perfect example of, seriously, there's got to be a better way of doing this while respecting the integrity of the single market.
Thank you. I have a question in the second row and also David in the first row. We'll take the second row first. Please, over here. If you put your hand way up, she'll see you. Thank you.
Alessandra Casale from Assonimed, Italian Association of Listed Companies. A comment on what has been said on the single supervisor. We are trying to harmonize the legislation since 1999. That was the first Financial Services Action Plan. Then we had other action plans, and after 25 years, we are still talking about the lack of harmonization. Why there is a lack of harmonization? Because there is not a single supervisor interpreting and enforcing the legislation in the same way. So we have not an harmonization at the end of the day. So we do not, I personally do not agree that single supervision is a matter of a wasting of time. I think that we need to go through a centralized supervisor. We need to go with small steps, as the Commission has proposed. And yeah, I think that we need to consider that if we didn't reach any harmonization in 25 years, it's also because we didn't have a supervisor interpreting the rules in the same way. And this is true also for the regulation, and not only for the directive. By the way, I wanted to ask if at least the modification of the governance of ESMA is a possibility, and you share this proposal of the Commission on the modification of the governance, making ESMA a little bit more independent from the national authorities. Mm-hmm. Thank you.
Okay, thank you. Who would like to speak to that? We heard, by the way, I did not hear a message that we don't need single or central supervision. What I heard is we need it with a local flavor. We need both. Is that right, Björn?
Yeah,
yeah,
that's right.
But does somebody want to speak to the ESMA point? Or Laurent, please, go ahead.
I think it's going to be very difficult to harmonize European regulation with 60 to 70,000 people working between national and European regulatory authorities. I think we have too many people thinking about too many things. And 99% of those people are within national regulatory bodies. So the question I have, and I'll revert to you, is how can we get that done with so many people with so many different objectives? My experience in our firm is that in any department where I have too many people, it becomes complicated and complex. And we don't focus on what's important. We don't focus on gaining efficiencies. We just turn it in circles. So at the risk of being a bit provocative, I think one of the problems might be this one, is to rebalance the power between the center and national jurisdiction, and perhaps trimming down the number of people thinking about regulation. I'm not sure you're going to like that. But,
Thank you. One more comment up here in the front. Here, David. Thank you.
Thank you. Well, as a long-standing veteran on all these subjects, allow me 3 quick comments. The first is Björn is absolutely right. There's been a lack of political will. We've seen that for a long, long time. I think we saw it in the previous commission. But I think William is right that at last we're seeing the first shoots of spring at last. And the big test is coming up in 2 weeks' time at the March 19 European Council. Now, it could get waylaid because of what's happening in the Middle East. But there, are we going to see 3 things? First of all, a clear set of mandates, a clear set of delivery deadlines, and if we follow the European the President of the European Commission, are we going to see deployment of enhanced cooperation where there are blockages? Because she said so in her informal conference. So March 19 is absolutely critical. And there, I think, we've heard, did we not, from the President, that she wants, Philippe, the agreement on the integration package, supervision and securitization by the end of this year. That's what was said. So, I mean, this is a big change if this happens and if it's followed through. I think 2 things have made life very complicated.
Briefly, if you would, because we still want to... Yeah.
Very quickly. 2 things have made life very complex. One is the political machinery and the legislative system in Europe, which has bred complexity. And second, and William has got closest to this, and I praise him for this, we've never really got our hands around the economic benefits for all member states of integrated capital markets. And the neither the Draghi nor the letter reports address that crucial point.
Thank you very much. That said, let's do one lightning round where each of you tells me what is the main thing you would prioritize to really get action moving after all these years of talking and not achieving. So the one single top priority for SIU to become a reality. And we can go this way down to...
You can't have capital markets union without capital. So if I ruled the world, every member state that doesn't already have it would have to have auto-enrollment workplace pensions, not Pillar 3 pensions, and they would not be allowed to contribute to any future Level 1 legislation until they're done so.
Philippe?
I want to say there's really no shortcuts here. We're trying to build an ecosystem, so we need to take a package of measures.
But you told us about all the different parts that need to be adjusted. Which one would you start with?
No, that's the point that I want to make, because all of this, if we want this to work, all of this needs to be in place. Now, the positive news is we don't need to wait, because we can get to work now. And that's the beauty also of this new approach we've taken, that member states can go ahead with some of the measures while we're still negotiating at EU level and work on pensions, work on savings and investments account, and also work on some of the even more tricky issues like securities laws, like insolvency laws, and like tax matters.
Thank you. Björn?
Get the investment saving account implemented across Europe. We have the solution. It works in Sweden. It works super well in Sweden, by the way. Let's just get it implemented across Europe. And then maybe one happy note to end with. Coming from outside into Switzerland, being here 2 years in Switzerland, the Swiss capital market is actually one of the best, if not the best, in Switzerland. Sometimes we sell ourselves a little bit short. We have one of the best ETF markets. Let's not forget Galderma, one of the best IPOs within the last couple of years. So the Swiss market is actually sometimes better than what we think. But that's a view from outside into Switzerland.
Thank you. Laurent?
I would say something which is also relevant for Switzerland. I would start by adding competitiveness in the mandate of European supervisory authorities as a secondary objective, because without that, we stay in a risk avoidance framework, and we all know that if you want to invest without risk, our risk-adjusted returns are going to be zero.
Thank you. That was a very interesting idea that came up in our last panel with Sam, saying essentially exactly that point. Nick?
Well, coming from Switzerland with a very federated system, and a bit to your last point that you just made, I think, having the impression that a savings and investment unit will work if everyone profits right from the get-go, it will never start. So I think the mindset needs to shift in Europe, that for the longer term and for the benefit of the entire European Union, some also, pills or sour pills need to be swallowed by one or the other member state first in order to profit later, I think is a very important mindset shift.
Thinking of European competitiveness as a public good that benefits all. Yeah. Thank you very much to all of you. This has been a very, very interesting exchange, a lot of very valuable suggestions about how we can move forward on this project that has been in the air for so long and bring it down to earth. Many thanks. Let's give them a warm round of applause, please.
Thank you, guys.
Thank you. You may return to your seats. We are almost at the end of this year's Swiss Finance Council conference, but not quite. We do want to wrap up after these very productive discussions that we've had today, and I'm not even going to attempt a summary of all the points that were made, and neither is Crystal, but she is going to close our conference for us, and it's my great pleasure to hand the stage back to you, dear Crystal, for closing words.
Thank you very much. Ladies and gentlemen, distinguished speakers, dear colleagues, as we come to the close of the 10th annual conference of the Swiss Finance Council, let me begin by thanking all speakers, moderators, and participants for a very thoughtful and engaging exchange. Today's discussions confirm something that has become increasingly clear over the past years. Geopolitics is no longer a background condition for financial markets, it's a defining force. Fragmentation, strategic competition, and shifting alliances shape capital flows, regulatory choices, and investor confidence across jurisdictions. Against this backdrop, one theme ran consistently through our conversations. Europe's prosperity does depend on strong, open, and competitive capital markets. Deepening market integration, improving investment conditions, and maintaining openness to trusted partners will be essential if Europe is to mobilize the capital needed for innovation, security, and the transition to a climate-neutral economy. Public finances alone cannot carry this burden. Europe must mobilize private capital efficiently, at scale, and across borders. This is precisely why the transition from the Capital Markets Union to the Savings and Investment Union is so consequential. Connecting savings to productive investment is not merely a financial objective, it is a strategic imperative. To achieve the required scale quickly, Europe will also need to attract external capital, capital that is stable, long-term, and aligned with Europe's regulatory standards and values. Switzerland is ready to be a constructive partner in this endeavor. Swiss institutions are deeply interconnected with European markets. We are major cross-border investors in European companies, infrastructure, and public debt. Switzerland is not outside Europe's economic and financial reality. It is embedded within it. The initialing of the bilateral 3 package last year marked an important step towards stabilizing and modernizing the relationship between Switzerland and the European Union. The consultation process in Switzerland showed broad recognition that stable and predictable relations with the EU are in the interest of both our economies. Notably, these bilateral agreements are being signed today here in Brussels by representatives of Switzerland and the European Union. Businesses, investors, and financial institutions on both sides benefit from a framework that reduces political uncertainty and supports cross-border investment. One practical opportunity lies in pragmatic approaches to market access, approaches that allow trusted third country firms to operate under transparent supervision and clear rules, can enhance legal certainty, improve oversight, and ultimately support Europe's ambition to attract global capital while maintaining a level playing field, all without undermining EU regulatory autonomy. The regulatory dialogue between the EU and Switzerland remains crucial, not only to maintain alignment where appropriate, but also to explore new forms of cooperation that strengthen European capital markets as a whole. The goal on both sides is fully compatible: stable financial systems, competitive economies, and prosperity for our citizens. Let me turn to regulation more broadly. Europe's competitiveness depends not only on market access, but also on the quality of its regulatory framework. The current simplification agenda, therefore, represents a major opportunity. Simplification should not be misunderstood as wild deregulation. Simpler rules are rules that are clearer, more coherent, more predictable, easier to implement and oversee. Complexity does not enhance financial stability. It often obscures risks, increases costs, and diverts resources away from financing the real economy. A regulatory framework that is proportionate, outcome-focused, and internationally aligned will make Europe a more attractive place to invest and do business without compromising consumer protection or financial resilience. The same applies to Switzerland. Global developments reinforce the urgency. Other major jurisdictions are actively adjusting their regulatory frameworks to support growth and competitiveness. Europe should do the same in a manner that is fully consistent with its values. Ladies and gentlemen, let me close with one final reflection. Capital markets are not an abstract construct. They are strategic infrastructure. They determine whether savings become innovation, whether ideas become companies, and whether ambition becomes growth. In a more fragmented world, Europe's ability to mobilize capital efficiently and attract it confidently will shape its economic sovereignty. If we combine integration, regulatory clarity, and openness to trusted partners, Europe can continue to be one of the world's most attractive places to invest, innovate, and live. The Swiss financial community stands ready to contribute to that ambition. On behalf of the Swiss Finance Council, I would like to warmly thank our moderators, our panelists, our speakers, and all of you for contributing to this dialogue. A special thanks goes to Esther Widmer and her team here in Brussels for organizing today's event. I now invite you to continue the conversations over the reception next door. Conferences like today's are obviously valuable not only for the discussions on stage, but also for the conversation that follow. So thank you for joining us, and I wish you a very pleasant evening.